Thursday, December 18th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, global stocks rattled by the Federal Reserve after the central bank said it's likely to cut interest rates less than previously anticipated come 2025 amid concerns of persistent inflation. Now, U.S. stock futures showing some signs of recovering this morning. After, though, the major averages sold off heavy amid the Fed's hawkish pivot here. Now, the Dow slid for a 10th day in its longest losing streak since 1974, while the S&P 500 saw its worst one-hour reaction to a Fed decision since the pandemic in 2020. The Fed's commentary sending ripples across asset classes as Bitcoin fell with treasuries, while the dollar saw its best day since 2022. Meanwhile, Magnificent Seven stocks are showing some signs of a comeback after recovering some of their losses, which led to the market's lower action that we saw yesterday following Powell's comments.
Plus, the odds of a government shutdown increasing after President-elect Trump and Elon Musk threw some cold water on House Speaker Johnson's spending bill. Trump saying that he opposes the funding bill and that he wants lawmakers to include an increase in the debt ceiling in the package. Elon Musk posted to X about the funding bill, get this, more than 100 times over the course of yesterday. He repeatedly called the bill, quote, criminal, and asked his followers to call their representatives. Now, the measure would have kept the government funded through mid-March. A shutdown is now expected to potentially begin at 12:01 a.m. Eastern Time on Saturday without any action from Congress.
And on the earnings front, Micron shares plunging this morning. The memory chip maker falling after its revenue forecast missed projections, hurt by weakening demand for smartphones and personal computers. Meanwhile, investors now looking ahead to earnings after the bell from Nike. New CEO Elliott Hill faces his first earnings call since taking the job in full quarter. Now, investors will have questions on the turnaround for the world's largest athletic wear company amid partnership woes, competition, after shares fell 29% year to date.
U.S. stock futures recovering some of their Fed-sparked losses after the S&P 500 saw its worst one-hour reaction to a Fed decision since March of 2020 at the onset of the pandemic. Now, the sell-off worsened as Fed Chair Powell had this to say about the potential for a rate hike next year.
We are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world.
All right, well, we heard Powell really throwing some cold water on some of the progress that many had thought or hoped at least that we would hear him talk about here. He talked about the fact that the Fed is not going to settle for inflation above that 2% target. We know inflation has certainly remained very sticky. We saw in terms of what the projections are move to the upside here and where Fed policymakers see inflation landing by the end of next year. And I think that when you take a look at the market's reaction, we are seeing a bit of a bounce back here this morning, and that is important to point out. You got all three of the major averages on track to at least open the trading day in the green. So we are seeing some buying opportunity, or some buying action, I should say, off of the lows and where we did close yesterday. But that pales in comparison to the sell-off that we saw, the degree of the sell-off that we saw yesterday, as so much of this uncertainty had been introduced. Now, on the heels of that, Powell was very adamant about the fact that he is confident just in terms of where the economy is right now, how strong that of a footing it's on. We got the GDP number out this morning, that reading at 3.1%, coming in slightly above expectations. You also had the jobless claims number coming in below expectations. That's good news there, just really proving the factor, at least further evidence that the labor market is holding up. And I think the question is the degree of that sell-off, whether or not markets are going to be able to recover, like at least the early action is indicating to some degree here this morning, or is this just going to be more of a dead cat bounce and we could potentially see more pressure as investors do have more time to digest some of that commentary from Powell?
Yeah, context is spot on here. I mean, this is in what we're seeing in the market activity at the gate early this morning. It's much like if you were to shoot a deflated basketball at a 10-foot rim, well, you're going to get some deflated type of bounce regardless of whether you make the shot or miss the shot. But ultimately, going forward from here, it's been remarkable to see some of the investor reaction. And I was taking a look at the note from BlackRock's Rick Reeder coming out after the print, and he was really zeroing in on what those who are focused in on some of the fixed income assets out there should be thinking about. And from an investment perspective, they hold that interest rates are not going to be the road to return success from here, but they also are looking towards the shorter end of the yield curve right now in order to clip some of the attractive yield and wait for more information to come in for the Fed to evaluate. With a still flat yield curve, attractive real rates as well, they say, of interest still. They think that income and fixed income is much more attractive than being in long-term fixed in one's portfolio allocation. So that, in addition to what we're seeing and you laid out in the equity market landscape right now.
Yeah, certainly. It's all very important to point out. And one more thing I wanted to note here before we move on is the S&P equal weight index. And we bring this up, we talk about this a lot when we're talking about breadth in the market and some of the movement that we have seen. And here we have a year-to-date chart, but I just want you to focus on the right-hand side of the screen, because where we closed yesterday was actually the lowest close that we've seen since September 12th. And I point that out because it's almost like the entire easing cycle then didn't necessarily happen in the markets when you see what was discounted there on the heels of some of that commentary from Powell. So again, when you put into context just what the movement we have seen, the degree of the movement, the selling that we did see following the decision yesterday, following Powell's comments, obviously, when things started to escalate, I think that just really further illustrates some of the uncertainty, some of the jitters that are in the market right now as you look ahead to 2025 when it comes to the further fight here to tame inflation. And then we haven't even gotten into the potential impact of Trump's policies as well.
Well, we're going to do it here in this show, everyone, so stay tuned. Well, how should investors be positioning themselves in the wake of the Fed's hawkish pivot that shook the markets here? Joining us now, we've got Carol Schleif, who is the BMO Private Wealth Chief Market Strategist here. Carol, great to have you here with us this morning. I just want to get your read in on what you heard from the Fed yesterday to begin.
Sure. First off, thanks for inviting me. A pleasure to be here. And we were a little surprised at markets, the vehemence of the market's reaction after the press conference. Powell did he tried repeatedly to help people focus on the fact that the economy is very strong. And actually, when you looked at it on paper and looked at even the announcement itself on paper, the fact that they're pushing out the rate cuts a bit. They're taking a slow and cautious approach, trying to position themselves to absorb potential policy changes coming in. But the underlying factor of the fact that the employment market is still basically strong, but they're watching it at the edges for some of those early signs of weakening because they don't want it to weaken further. But the economy itself is very strong and firing on a number of fronts. And that means that inflation doesn't come down as fast as they had thought. And when you roll back to a year ago, most investors a year ago were discounting 7 rate cuts or 175 basis points of easing this year. We got 100 basis points, and yet markets still have done well on a year-to-date basis. And so those summary of economic projections change a lot from period to period. And so we wouldn't read too much into those, as we do think the Fed has relegated us again to being data dependent and higher for longer.
So, Carol, then should investors be buying the dip? I guess when you take a look out into 2025, we are seeing some green here across the screen this morning. This market recovery that seems to be at play, is that going to stick?
You know, it's interesting. There will be a lot of volatility, and our house view is expectation for pretty dramatically increased volatility going into next year, particularly early in the year. Now, we'll see a lot of policy changes. We'll see a lot of policy trial balloons floated. We already are, but we will assuredly see a lot happen in January, but we'll also get a whole raft of earnings and a whole bunch of companies telling us how they're positioning for the year ahead. So there should be some opportunities in here if you've got sideline cash to step back in. With that said, keeping that diversified portfolio, making sure you have some shorter term fixed income in there to act as ballast to the extent that you are stepping in a more aggressive way for equity positions, and looking in some of the unloved places too in mid cap and small cap.
Which sectors do you think presents the most opportunity?
Well, we think there's still opportunity in broader technology. We like industrials and have for a very long time because we definitely think that that play of improving the grid, building out data centers, deploying technology, a lot of that stuff is just in the early days, and we will continue to see that. There's some areas in healthcare that are interesting, particularly in biotechnology and some of the other areas that will benefit from the deployment of artificial intelligence. And financials, especially some of the mid-cap and smaller cap financials, can be interesting, especially if we go into a regime that has a lighter capital requirements and lower regulation.
Carol, real quick, the other looming factor here among the markets, at least in the short term, is this potential government shutdown. I'm curious from your perspective, how much of an uncertainty, how much risk does that then introduce, at least in the short term?
It definitely introduces some risk, but typically government shutdowns don't impact the markets too much. The markets are going to look through that. And it's important to remember there are a lot of people that have significant gains for the year. They were taking some off the table. I suspect there'll be a lot of people trying to take a breather over the next couple of weeks. We'll probably see lighter volume and things that way. So we wouldn't read too much into it, because I think there will be a lot of activity, a lot of market action, and a lot to react to starting it right away in January.
All right, Carol, thanks so much for taking the time to join us here this morning.
Thank you.
Well, Fed Chair Jay Powell signaling the central bank's focus has shifted solely to inflation after its year-end inflation projection has, quote, kind of fallen apart. Joining us now from where we want to bring in Tom Porcelli. He's PGIM's fixed income chief U.S. economist. Tom, it's great to have you back on the program with us. Let's just dive deep into what we heard from Powell yesterday. Clearly, it was enough to rattle the markets a little bit. There is a bit of a reassessment, I think it's safe to say, going on as to what Fed policy is going to look like here in the new year. What was your biggest takeaway just in terms of some of that uncertainty that seemed to be introduced from Powell?
Yeah, great to be with you as always. Yeah, look, I think, when I look at the market reaction, I think, what did he say that was so different relative to expectations? And I would argue there was not really much. The market reacted how it reacted, and that's fine. But when you consider what he said relative to what most of us thought he was going to do, I think it was pretty in line. So let's just get that out there first. I think, to me, one of the biggest challenges for the Fed is, they keep on saying they're data dependent, but I actually think that's not quite right. I think they actually are data point dependent. And that, to me, is a bigger problem, because you cannot be swung around by every single monthly data point. So let's use an example of the coming payroll report, right? We're going to get a payroll report in 2 or 3 weeks. Let's say it's a clunker, right? It's a really bad number. What do you think the market is going to do with that? The market is going to start to price in more cuts, right? So I think the problem for the Fed right now is one of narrative. And the unfortunate truth is we're dealing with some really volatile data. I mean, the data have been much more volatile post-COVID than it was pre-COVID. And I think that's one assortment of factors which we could do a whole segment on it in and of itself. But my simple point is, what I see being set up from yesterday is more volatility in the months to come.
And so what does that hold for the Fed? I mean, it seems like that just pushes them even more into the data dependency oblivion, if you will.
Yeah, I think that's right. I mean, look, the market hasn't done a great job of forecasting where funds was going to go, right? I mean, think about where we were at the beginning of the year. Think about where things were in the middle of the year. Think about where things were just a couple of months ago. And now think about where we are today. I mean, it has been a pretty wild roller coaster. And look, we should not be dogmatic about any of this. No one should be. I mean, if the facts on the ground change, they change. But look, I would argue that from an inflation perspective, inflation continues to move in the right direction. I think we can have a debate about the speed with which it is moving, but we were meaningfully higher just a year ago relative to where we were today, or even 2 years ago relative to where we are today. I mean, inflation has slowed down. The unemployment rate is up. I mean, there is some braking power that's being applied to the economy right now. And so when the Fed says things like, hey, we're restrictive, they are restrictive. And you can see that show up pretty clearly in lower inflation and in a higher unemployment rate.
Sam, what do you think this means more specifically for the bond market? When you take a look at the movement that we're seeing in yields, there's been lots of talk, or more chatter, I should say, about 5%. You had T. Rowe Price throwing out the scenario earlier this week of potentially 6% here for the 10-year yield. How dramatic of a move higher do you think we could potentially see, given some of this hawkish rhetoric?
Yeah, look, I think we're in the range, right? I mean, if I look at 10s right now, we're at 454. To me, the right way of thinking about this is drop a pin in this number and draw a circle 25 or 50 basis points on either side. That, I think, is going to be your range on 10-year yields. People keep on saying higher for longer. I've said many times, I actually don't like that idea. I think that's a misnomer. It's not higher for longer. It's normal for longer. I mean, this is a relatively normal range. I mean, there's been a couple of outliers over recent decades, right? The 1980s. And then even as recently as the post-GFC window. But generally speaking, I think this is the right range. So I think, when you think about 10-year yields, think about where you think Fed funds will average for the next 10 years. And if you can come up with that number, then that's where 10s are supposed to sort of sit. And I would argue that, again, this 450, 25 or 50 basis points on either side is probably the right way of thinking of it.
Tom Porcelli of PGIM, thanks so much for taking the time here with us. Really appreciate it.
Thank you. Good to be with you.
Likewise. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street as stocks look to recover some of Wednesday's losses. Plus, we break down Micron's results as the memory chip maker plunges on its forecast. And we push ahead to Nike after the bell. Their CEO, their new one, preparing for his first earnings at the helm. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk about Micron. They say check in on your friends, and we're doing just that. Micron down bad, 11% right now, issuing disappointing guidance for its current quarter, hit by weak demand for smartphones and personal computers. Still, the chip maker beat expectations for its fiscal first quarter, boosted by sales of AI-related chips. The company's CEO saying they expect a return to growth in the second half of the fiscal year here. If you were listening into this earnings call, though, you really did get a lot of color around what they're anticipating, not just in the PC refresh cycle, which they say is unfolding more gradually. So that's going to take some time. Also, they're expecting the units there to grow in the mid-single digit range in calendar 2025, weight towards the second half of the year. Also, smartphone unit volumes, not expecting too much, but remaining on track to grow in the mid-single digit range. Expect low single digit percentage growth in 2025. Consistent rather with their prior expectations. What does all of this mean? It just means investors are going to have to wait for longer to see some of the results really play out and get and feel comfortable pricing that into the valuation for Micron as well, when you are pushing out everything from PC to smartphone, from automotive demand even that they talked about on the call, and that being a pass-through for Micron and benefiting their financial performance.
Yeah, we're also seeing the ripple effects across the industry, right?
Yeah.
When you take a look at some of the competitors, some of those within the space, AMAT, Lam Research, Western Digital, among the names that are being dragged lower on the heels of this forecast disappointment from Micron that we are getting out this morning. And I think you're exactly right, Brad. You talk about the recovery, maybe potentially what we could see in the smartphone business and in the PC market. The fact that we are still seeing weakening demand there, weak demand there, obviously a worrisome, challenging factor here for the company, at least in the coming quarters. There was a number of analysts out this morning, either adjusting their price targets, some downgrades on the stock this morning. Bank of America was one of those analysts coming out. They actually cut their rating to neutral from buy, talking about that weakness in the PC market and in the smartphone market. But they also went on to say that they're more focused on gross margins, the fact that they're staying weak in the second quarter, saying that they could actually potentially stay weak in the third quarter. And the reason why that is so significant and why they are pointing to that is because historically speaking, the stock has struggled when we did not see some of the expansion here from gross margins in the past. It was tough to find scenarios of outperformance when this exactly has been the case. So the fact that that is likely to remain muted now potentially here, at least through the first half of the fiscal year, potentially into the third quarter, a real challenge here for Micron as we do try to figure out to the degree of this slowness and how long it's going to take in order to regain some of that lost momentum.
Yeah, and a longer term margin impact as well. Here's some pressure that already showed up in this most recent quarter.
All right, let's take a look at Lennar. It missed its fourth quarter profit and revenue estimates, with potential buyers staying on the sidelines due to volatile mortgage rates. The company's executive chairman and co-CEO Stuart Miller saying that the housing market, quote, proved to be far more challenging than it seemed in the fourth quarter due to the interest rate environment. I think that's clearly reflected in a lot of these numbers that we are getting out. But you're looking at Lennar, those shares off nearly 8% here in the pre-market. So you've got the guidance falling short of expectations. You see this risk now potentially reflected across the broader industry on the heels of those comments from the CEO at Lennar. Also, what we've heard from some of the other home builders here over the last couple of weeks. I think that there's more of a consensus that maybe this is a reflection of some of the challenges across the broader home building segment. What stuck out to me in these results with some region-specific numbers. When you take a look at where exactly that pressure was, a lot of that pressure was actually in the East. When you take a look at the East Coast, that fell 19%, the drop in sales there. That's very significant. So when you have higher mortgage rates, it's driven management to use higher discounting, which is obviously affecting margins. One of the concerns here about what is necessary in order to boost that demand, when we talk about the fact that housing affordability, if not getting worse, obviously remains a massive challenge with elevated prices and mortgage rates that have remained very, very sticky here over the last several months.
Yeah, one huge thing jumps out to me whenever I read through some of the housing build and home builders reports here, and that's what they have in backlogs as well. The range that they had provided previously had a low end of about 19,000 homes. That was their previous guidance. That came in the fourth quarter. Sales pace lagged expectations, interest rates climbed, new orders fell short of expectations to 16,895 homes. That was well below the low end of their previous guidance of 1,900 homes. And so one of the things that we're going to have to track going forward from here is the affordability complex that you were mentioning a moment ago, where we've already got data week over week from Freddie Mac, where we're continuing to look at, even within the moderation of the mindset for consumers right now that are trying to figure out, okay, at what timing of the interest rate and mortgage rate market, can I feel like I'm still getting some type of deal? And on the other side, you've got the new home builders that are recognizing that they might still need to have some type of incentive, whether that be a buy down in mortgage rates that actually impacts their margins in the near term, in hopes that they will just be able to fill some of the order book as well. So that's something that is worth tracking going forward here. Net of incentives, though, per home delivered $430,000 in the fourth quarter, slightly down from last year. Also, let's go to the swoosh, why don't we? Nike set to report its fiscal second quarter results after the market closed today. It's going to be the first report since Elliott Hill took over as the CEO. Investors are hoping to hear a detailed turnaround plan for the footwear maker. Nike withdrew its full year guidance in October to give Hill more time to develop some plans here. And there's a few things that are going to be in focus going into this report, not just what the innovation cycle looks like for the company from here, but also how this company is going to be able to continue to regain some of the partnerships and relationships with its wholesale distributors and retailers as well that it's worked with. They had a massive shift in strategy years back, really leaned into D2C like everybody was doing, and that kind of being spurred by Lululemon that really did it well and was able to have even more of an entrenched customer relationship. But Nike had so many retailers and partners that were really baked in to the stock performance for decades that when you really kind of cut off the spigot on some of those other tentacles within the retail landscape, then that's going to have to get factored into how the investors are perceiving the overall growth trajectory, the inputs that you have into other shelves that are not owned and operated by you, and thus where the consumer is seeing you as well here. So I think we're going to hear a little bit more about that from Nike as well going into this one.
Yeah, I think Wall Street's just very eager to hear what exactly these turnaround plans look like from Elliott Hill. We really haven't heard much. He made some comments to the staff during his first week on the job saying that, yes, it is a tough environment right now. He also went on to say that what we have done before is we have been able to win when we have been in tough situations. He wants to get back to that sharp focus on the consumer. So I think any more details as to what exactly that looks like is obviously something that Wall Street is very, very eager to hear. They talk about the ability here and how quickly Nike will be able to repair some of the damaged relationships here just on the partnership side, talking about getting back to that cool factor, some cooling demand for their pipeline, what exactly that looks like for Nike going forward. So again, I think a lot of this, rather than it being on, like you were saying, the decline that we have seen, the fact that we are expecting to see third quarter in a row of declining revenue, but more so on that outlook and what exactly Nike's going to look like a year, 2 years from now compared to what it looks like here today.
I'm pumped. I can't wait.
Of course you are. One of their top customers.
I mean, yeah, there's like a line item for me in the financial performance. Yeah.
The least surprising thing. All right, coming up, we've got the opening bell on Wall Street. Stay tuned. We'll be right back. And that's the opening bell on Wall Street. Let's do a check of the markets as we ring in a new trading day. I think many investors are hoping to forget some of the selling that we did see yesterday to end the closing day. Of course, that selling pressure coming on the heels of the latest Fed decision, but more so on the commentary from Powell and exactly what the path forward could potentially look like for rates going forward. Some of that hawkish rhetoric obviously reflected in yesterday's risk-off tone that we certainly did see. We actually had the Dow, though, opening in the green. The reason why this is so significant, it's actually closed down 10 days in a row. So it could potentially snap that streak if we do hold on to these gains. You're looking at gains of just about 0.7% here at the open. You've also got the S&P recouping some of its losses, just some, from yesterday. It's up just about 0.8%, nearly a percentage move to the upside. You also have the Nasdaq the Nasdaq Composite calibrating here, up just about 1%. We certainly did see pressure across the board, but many of those larger cap tech names were really among the biggest decliners yesterday. I also want to point out the action that we're seeing play out in the bond market. We just talked to PGIM's Tom Porcelli earlier in the program. I asked him just about what exactly that range could potentially look like on the 10-year yield as we do get more of this hawkish commentary coming out from the Fed. And he was saying 25 to 50 basis points in any direction. So I would put the upside limit here, at least from his view, on that 5% level. You are seeing a bit of a move to the upside here this morning, just above that 4-5 level. Flipping over to that sector action again. Yesterday, it was a sea of red on the screen. This morning, at least here at the open, a bit of a different picture. You are seeing, it looks like, a little bit of a buy the dip mentality going on Wall Street. You got consumer discretionary communication services among the outperformers. Financials not too far behind. In terms of what is in the red, consumer staples just below, or right at the flat line, I should say. You've got healthcare, a bit of an underperformer here this morning. And I just want to bring up the Nasdaq 100, and I bring this up because of the extent of some of that selling that we saw yesterday, specifically Tesla. When you take a look at that drop of just about 8%, we are seeing a bit of a rebound here this morning. You got Tesla shares up just about 2%. Nvidia also back in the green, as well as Google, Amazon, Meta, Microsoft. You get the picture. A lot more green on the screen here this morning, although it is very early. You do have Apple still trading in the red. But again, it looks like investors at least looking at yesterday's move to the downside as a potential buy the dip opportunity, at least for now. Let's kick it over to Jared Blickery. He's got a closer look at some of this movement that we're seeing. Jared.
Hey, Shauna, thank you. I want to start with the Dow. As you said, 10 days down in a row. I'm going to put a 2-month chart on with some candlesticks. And you see this big red candle that I'm highlighting here? That might just be an exhaustion candle. We did see the biggest selling pressure of the year yesterday. But in terms of what the VIX is doing, and some people call it the fear gauge, not Steve Stosnick, but you can see this huge green candle on the VIX here. And it relates to, and it's comparable to this candle that we got on August 5th, and that was the so-called Yen-mageddon. That's when the BOJ had some issues overseas, and that carried over into the U.S. stock market. That was a much bigger spike. However, I'm going to go back to a 2-month here to put it in perspective. These do tend to be one-off events, so I would not be surprised to see stocks race up to see their record highs again, but this is a warning shot, and we might see some more instances of risk-off behavior as we get reports in the coming weeks, and there's not going to be a lot of news, so I think that's going to be a tailwind to markets rather than a headwind. Here's the 10-year T-note yield, and this is notable because this is the highest level that we've had since May. This is a 2-month. I'm going to show you a year-to-date. It has now surpassed the high that we saw in November, the post-election high, and higher rates and a higher dollar, which we're going to look at right now. U.S. dollar at a 2-year high. These do tend to weigh on equities. And so the U.S. dollar wrecking ball kind of a thing, I was breaking it down a couple weeks ago. I think that's going to be a headline in 2025. Might be incoming President Trump's biggest problem, a true strong dollar. So think about that there. Let's go back to the sector action. Shauna was saying consumer discretionary was the leading sector. It's still trading places here with financials. It got a drubbing yesterday. I'm going to put a two-day chart on here, and you can see consumer discretionary with its gains today. It is only the second worst off, but this has been the highest flying sector since the election, and so I think that's a notable reversal. You can see that in Tesla and some other stocks here, but I wanted to get to Bitcoin. Bitcoin is what I'm going to close on here because we had a huge risk-off day yesterday. This is the two-day chart. We hit about 98,000 and change, and we're back above 100,000. So it looks like 100,000 is that big psychological level in play with a wide band around it. Probably need to get to 110,000 to see the troubles in the rear view. Guys?
Jared, thanks so much. Teeing up today's market activity for us. Appreciate it. Time now for today's strategy session. The Russell 2000 saw its biggest sell-off since 2020 following the Fed's hawkish pivot. But could small caps be a safe haven strategy to play? Joining us now is Dana DeOrio, who is the InvestNet Solutions Co-Chief Investment Officer. Dana, great to have you back on the program with us. So let's just start with that question. Could small caps be a safe haven amid some of the volatility here?
Well, I think it's always important to talk about this in terms of the time frame that you're thinking about, right? So, I mean, small caps are, you have to be thinking very short term to be thinking, small caps in the short run could or could not be a safe haven. I think small caps are obviously more volatile, generally speaking. Now, over the long haul, they have tended to pay off for investors. Particularly when you remove the growthiest small cap stocks, which are sort of lotto ticket type payoff. So I very much support small caps over the long haul. I think when you're thinking in terms of cyclicality and where you want to sit right now, if you're concerned about potential volatility, small caps are a tough play because of course they're more interest rate sensitive. Obviously, so the prospect of higher for longer was very bad for small caps in the short run, and risk off in general hurts small caps. So safe haven, I wouldn't look at them that way, but long-term value creation, yes.
So Dana, I guess for investors that are looking for that safe haven exposure, right? They do still want to stay invested. They're a little bit worried about, clearly there is some reflection of that played out in the markets yesterday. Where is that? Is that tech still, or I guess how should they then be balancing some of that risk?
It's a great question because I think obviously in the last several years, tech has kind of become synonymous with defensive, right? It's that, when there was trouble in the market, we see tech kind of do well, because these are huge names, very well capitalized, not reliant on capital markets in any way for funding. And so, you see money kind of flow over to these names, of course. But we also exist in a place where we have obviously a very high level of concentration in the indexes. And most people, if they're not actually market cap weighted, index tracking, they're in some sort of active portfolio that has to be at least benchmark conscious, right? And so tracking error is a consideration. And if you're sitting there, it's really hard to be very far from big tech. So I think plowing even more money into big tech, kind of exacerbates that concentration issue for you. If, the traditional place to sort of sit in the markets, if you want a little bit of padding, is something more like defensive, true defensive, which would be quality indicators, right? And or low volatility indicators. So quality on the fundamental side and low vol, minimum variance on the technical side are places that you can sit.
How can investors identify quality names when you do have high volatility like we're seeing play out right now?
Yeah, easy ways to get in is, you have quality ETFs and mutual funds and plays that'll filter around quality indicators like, accruals, like high profitability. Really the research tells us that profitability, not bottom line profitability, but a little bit higher up on the income statement is a pretty good indicator of quality. It tends to pay off over time. Not only is it a place where you sort of have this asymmetric benefit that you can kind of hang out in these stocks, and it's not to say they won't suffer, right? Nothing is for sure, but it tends to be the case that there's an asymmetric benefit to reducing volatility, being in quality type indicators, and yet you don't lose as much return as you would expect you would. And then over time, these quality types of stocks do pay off if you sit with it long enough. But again, there's two sort of ways of looking at that. One is fundamental indicators like profitability. The other is looking at just what is the performance of the stock, how volatile is that stock, how much of a contributor to volatility is it to the overall index.
Dana, when we talk about volatility, we certainly have seen this risk on sentiment with the obviously exclusion of yesterday and some of the one-off days, but we have seen this march higher. And what's been remarkable to us and what we have talked about so many times here at Yahoo Finance, especially over the last 5 weeks or so, is the move to the upside in Bitcoin. And I bring that up because you mentioned that in your notes, some of the opportunity that you are seeing investment-wise. I guess my question is, how much exposure should investors be looking for at this point to crypto, and what makes the most sense as they are trying to balance some of that uncertainty?
Yeah, I think it's it's a beauty in the eye of the beholder, I guess, right? We don't have a particular statement that you should be in crypto or not be in crypto, but we are seeing more use of crypto now that you have the SEC has approved these ETFs. Obviously, you have big name asset managers with a crypto ETF out there that the investor is able to invest in and get the return on crypto without having to worry about cold storage, wallets and all the operational concerns that they might have to by owning the actual Bitcoin. So I think that, of course, opened up a whole new investor base. The fact that you have these ETFs available, we're seeing obviously money on the InvestNet platform going to these ETFs. It's relatively low at this point, but just the fact that the advisory community now oversees money in crypto, I think tells you something about how it's changed over time in terms of its investment potential. And I also think investors, to a certain extent, like the lotto payoffs that crypto potentially offers, right? There's sort of an asymmetric benefit there, especially when you see what crypto has done over the last, last month or so, right? Is there's this massive potential lotto payoff. And, even a typically risk-averse investor, having a little slug of that 1% or whatever, they might actually appreciate in the portfolio. So it doesn't mean it's not incredibly volatile. Even at a small amount, it will raise the volatility of that overall portfolio. You have to bear that in mind.
Dana Diorio, always great to have you of InvestNet. Thanks so much for taking the time. It's time now to get to our chart of the day. Let's send it over to Catalyst co-host Madison Mills for a look at the Mag 7, Maddie.
That's right, Shauna. Taking a look at Mag 7 performance under a variety of interest rate conditions here in the United States. I wanted to pull this chart looking at the Bloomberg Magnificent 7 index compared with the federal funds target rate. Here you can see prior to that 50 basis point cut when rates were at their peak, we saw a huge run in the Mag 7. And then we get that 50 basis point cut. Actually, the peak of the Mag 7 in terms of performance on price is equal to the peak that we got after that post-election rally. And I point that out to indicate that Mag 7 returns were looking amazing even in that overly hawkish environment. And that is my big question coming into today after the huge sell-off that we saw yesterday, clearly impacting all 7 of the members of the Mag 7. What is that trade going to look like if we do get a more hawkish Fed to come? I talked to several investors about this morning. Jay Woods in particular telling me that this sell-off, it was actually dramatic in his view, but not surprising given this degree of run-up that we have already seen in the market. Kevin Gordon adding here that these big tech names have significant cash on their balance sheets and the free cash flow to withstand a higher for longer environment. And Dana Daria just telling you guys this idea that tech can be defensive and seen as a safe haven when there is volatility in the broader market. And perhaps that is what we are going to see with the Mag 7 throughout today's trade, you guys.
Maddie, thanks so much. Appreciate it. Coming up, everyone, the Fed's hawkish tone initially sent the dollar surging to a 2-year high. We check in on the currency's latest moves next. Shauna?
All right, before we head to break, we want to turn your attention to Micron because shares moving significantly lower. You're actually looking at the biggest decline that we've seen since 2020, looking at a drop of just over 16%. The move to the downside coming on the heels, a very weak forecast coming out of Micron, and it's actually doing enough to weigh on the sector at large. You got Applied Materials, Lam Research, KLA, Western Digital among the names moving to the downside here. Again, just weakening demand here when you take a look at smartphones, when you take a look at PCs. That, of course, is playing into that weaker than expected or challenged forecast that we did get out from Micron. So again, shares posting the biggest decline that we have seen so far since 2020. We'll be right back.
it's appropriate to move cautiously and look for progress on inflation. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
That said Chair Jay Powell at yesterday's presser, the FOMC now projecting only 2 rate cuts that are likely next year. This hawkish stance initially sent the U.S. dollar surging to a 2-year high. We're now seeing the dollar essentially flat here in early moves. So we want to bring in Terry Wiseman. He's a global FX and interest rate strategist at Macquarie. It's great to have you here, Terry. Let's talk about the move that we have seen in the dollar. We have the hawkish Fed did send yields higher. Now we have the initial move in the dollar. It looks like things are settling just a bit. I'm curious what you think this tells us just about the trajectory that we could see from here for the U.S. dollar.
Well, it's altogether possible that the dollar can strengthen further. Keep in mind, I'm saying this not just because the Fed was more hawkish. Certainly the Fed was more hawkish. And I think the reason it was more hawkish was because it's starting to anticipate some inflationary pressure coming from the agenda items in President-elect Trump's policies. But the other reason that the dollar has strengthened, and I think this is somewhat underappreciated by participants in the market, is that all the other central banks are sounding more dovish. You have seen the ECB see the imperative of nearly promising that it's going to be continuing to cut rates. You have seen the Bank of Canada cut rates, and pretty aggressively at that, by 50 basis points. You have seen the BOJ delay their rate hikes, seemingly, with the statement that came out last night. You have even seen the Bank of England, although they did not cut or increase rates, they kept their bank rate on hold. We saw more dissent with regard to the hold. In other words, there were people on the Monetary Policy Committee that wanted the BOE to cut. So as the Fed is getting more hawkish, all the other major central banks are getting more dovish. And that is the flip side of the dollar, of the story around the dollar strength. And the reason these central banks are getting more dovish is because they, on the other hand, see the potential for U.S. import tariffs being disinflationary for their economies, even though those same tariffs could be inflationary for the U.S.
And so how does the strong dollar impact the fixed income asset class and investor strategy going forward?
It depends where you look. If you see a stronger dollar in the U.S., and we're saying all else equal here, you would think that it conceivably could bring long-term yields somewhat lower than they otherwise would be, just on the back of the Fed's policy. Why do I say that? Because, of course, a strong dollar does promote some disinflation in the U.S. In fact, that's one of the reasons why the Fed wants to be a bit more hawkish. Maybe it believes that to the extent that it wants to help inflation come down further, it needs a stronger dollar. Can't rule that out. But remember, the impacts and the effects and the events that are going to sway the fixed income market, there's a myriad of them besides what's happening with the currencies. There's the deficit in the U.S. There's the prospect of U.S. inflation independently of what happens in the currencies. Those are things that are going to affect fixed income markets just as mightily as what's happening in the currency market.
Terry, I'm curious what you make just from a global perspective. Obviously, we had the move in the pound coming on the heels of the 3 BOE officials voting for a cut. Then you have the move in the yen moving to the downside after we got this dovish central bank meeting over from the BOJ. What's your assessment there just in terms of, are there opportunities outside?
Well, yes, there is an opportunity, and I think it is somewhat connected to the premise that foreign central banks will be more dovish going forward. That opportunity is really in the stock market. It's the premise that the U.S. stocks have outperformed foreign stocks for so long, and the divergence in valuation has gone on for so long that maybe we should look for an opportunity for rotation out of the U.S. and into foreign stocks, simply on the premise that the Fed is getting more hawkish and it's the other central banks that are getting more dovish, and therefore may perhaps in a better position to help support their equity markets through that dovishness.
Interesting. Okay, and so what type of balancing then should investors be considering as they're looking across the balance of domestic and looking at the U.S. dollar versus other foreign currencies?
Well, it's always good to have a diversified portfolio, and I would never advocate having all of one's chips in one country basket. There is a case to be made for reallocation into Europe in 2025, potentially away from the U.S. that case could rest on a few things, but of course, we're going to need to see the good news for those countries, for the foreign markets come out in 2025. Where could that good news come? It could be conceivably from ceasefire talks in the Russia-Ukraine war, which I think could energize interest in the European markets. It could be that the Europeans, the EU, and some foreign countries, Canada, Mexico, concede to the U.S.'s demands with regard to things that are important to the U.S., like national security issues, like defense spending in Europe. And as a result, we get a situation where we are able to circumvent or preclude the imposition of U.S. import tariffs. If that were to happen, you could see those foreign markets do well in 2025. That could be the basis for that reallocation as well.
Terry Wiseman, thanks so much for taking the time here with us this morning. Appreciate it.
My pleasure.
Coming up, everyone, we've got some trending tickers for you. We'll give you the news behind the moves next. Before we head to break, though, we're taking a quick look at shares of U.S. banks this morning. This is after they suffered a big sell-off following the Fed decision yesterday. Then you're taking a look at some moves higher for Bank of America, B of A, Wells Fargo, Citigroup, as well as Goldman Sachs and JP Morgan as well. All of them seeming to be higher around 2% or in the ballpark for B of A here. We've got much more on the other side of this short break. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. First up, let's check in on Amazon, ticker symbol AMZN. Workers and contract drivers in 4 states walking off the job this morning less than a week before the holidays. The International Brotherhood of Teamsters confirming the strike, writing, if your package is delayed during the holidays, you can blame Amazon's insatiable greed. The Teamsters say that they called Amazon to the bargaining table and were ignored. Amazon says they don't expect any impact to operations. In a statement to Yahoo Finance, Amazon says for more than a year, Teamsters have misled the public, quote, claiming that they represent thousands of Amazon employees and drivers. They don't. And this is another attempt to push a false narrative, end quote.
Taiwan-based iPhone maker Foxconn reportedly in talks with Nissan Motors' biggest shareholder, Renault, about buying its shares in the Japanese automaker. This is according to Taiwan's central news agency. Now, Foxconn reportedly approached Nissan directly about a stake, but Nissan didn't respond so well. Nissan also reportedly considering a merger with longtime rival Honda amid some financial struggles. We've reported on that, what that could potentially look like here, whether or not we could see some pressure on a regulatory front here over the last couple of days. But you're taking a look at Foxconn shares. Those are off just about nearly 2% today.
We're also tracking another automaker, German automaker Volkswagen, VW, nearing a new labor deal that would allow factories in Germany to remain open. This is according to Bloomberg. Now, management would keep plants open and secure jobs until 2030, but workers will have to give up their bonuses. The company would also shift some production out of Germany to trim costs, and this comes as the automaker struggles with falling EV demand in the U.S. and Europe amid waning market share in China as well.
All right, well, that does it for Morning Brief. But keep it right here on Yahoo Finance. My co-host Madison Mills and I will have you for the next hour. We got much more analysis on the biggest catalyst driving today's action. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get a look at the three catalysts that we're watching this hour.
First up, we head to Washington to break down everything from the Fed decision to the looming government shutdown.
Plus, we sit down with Senator Cynthia Lummis to talk the year of Bitcoin and the potential for strategic Bitcoin reserves.
And award season continuing here at Yahoo Finance. Today, we bring you our comeback of the year. You won't want to miss it.
Let's take a look at some of the market headlines to start the hour. This is sponsored by Tasty Trade. We want to draw your attention to a bit of a rebound that we're seeing play out right now on the street, following on the heels of yesterday's brutal sell-off that we heard after Jay Powell started his press conference. We got the Dow now up just about 275, so slightly off the highs of the morning, although we haven't seen it drifting too far from that level. You've got the S&P also up about 0.75%. You've got the Nasdaq also up around the same amount there. You talk about a bit of a bounce back that we are seeing here across the board, especially when you take a look at some of those Mag 7 names. We saw the brutal selling going on yesterday for Tesla. You got Tesla almost leading or amongst the leaders here in some of today's moves to the upside. Flipping over to the bond market, we certainly have seen a lot of activity play out there. You got the 10-year yield right around that 456 level. Again, lots of speculation about as to how high rates could potentially climb given this hawkish rhetoric that we are getting from the Fed now. And let's take a look at Bitcoin, because we are seeing Bitcoin now actually moving to the downside still, off just about 3%, still holding above, though, that $100,000 level, well off the highs, though, that we saw earlier this week, Maddie.
And I think it's interesting in the context of some of the economic data that we got out today as well, in particular with regards to GDP, getting a surprise upward revision, also a surprise upward revision when it comes to factors that contribute to that core PCE data as well here. And I think it points to this question that came out of the meeting for me yesterday. What type of inflation is the Fed anticipating for 2025? And is it a type that this market is already accustomed to growing in spite of and alongside, versus a type that could potentially lead to headwinds for the consumer and cause a real issue this year?
Yeah, certainly. And Maddie, when you take a look at some of the commentary that we did get from Powell yesterday, one of the big takeaways, and obviously why we saw maybe the market react the way it did, was because of that hawkish stance that we did get from Powell and some of the cautious moves that maybe we could see from the central bank next year. And that more hawkish stance really spring what seemed to be Powell's phrase of the afternoon, which was slower pace. Take a listen to this.
It will be appropriate to slow the pace of further adjustments. The slower pace of cuts for next year, the slower rate cut path, slow the pace of rate cuts, slow the pace of adjustments. When the path is uncertain, you go a little bit slower. You just slow down.
So clearly, when it comes to what is the big issue here for the Fed going forward, obviously a lot is at play, but really what is front and center, what has been garnering so much of the reaction from the street this morning is obviously inflation, where we are in the fight to tame inflation, how high inflation is going to remain here. Talk about the fact that projections that we got out from the Fed obviously higher than what we had initially seen in terms of where inflation will land at the end of next year, right around that 2.5% level, which is well above that 2% target. Yet Powell reiterating the fact that they aren't going to drift away from that 2% target. So again, I think just the market trying to just reassess just what exactly, not so much higher for longer. There's been lots of questions about ultimately what that means on a longer term scale. But again, just a higher level that we are at now and what we could be at looking ahead to 2025 with only 2 rate cuts, we certainly are seeing a bit of a repricing going on in the market.
Especially because it's become increasingly clear how difficult it is to predict what the Fed is going to do in this environment. Obviously, Powell talking about that slower pace and the market sell-off happening off the back of that was very significant. Just to walk viewers through it, that wipeout of over 95% of stocks in the S&P 500 yesterday, a huge pop to the upside in the VIX, seeing a lot of volatility going as high as 28 yesterday. Now, some of that volatility coming out of the market this morning, and we are seeing a bit of a correction. But in my conversations with investors yesterday and this morning, there is still a little bit of a question in their voices about where the year is going to end up and if the chunk of gains year to date that we've seen come out during this sell-off is really going to be recovered, and if maybe some of those bullish price targets for 2025 are going to look a bit different as we do head into next year. We're going to continue on the question, what does a slower pace of rate cuts mean for investors next year? Joining us now, we've got Kayla Cedar. She's a macro multi-asset strategist at State Street. We've also got Michael Hands, the Chief Investment Officer at Citizens Wealth. Thanks for joining us, guys. I want to start with you, Kayla. Where do we go from here? Obviously, we have started to see a recovery in the market today. What's that recovery going to look like heading into year end?
Yeah, thanks so much for having me, Madison and Shauna. I would say, this is a really good reminder that when we look at equity markets, we really need to look at, high quality growth parts of the market. And so moving into 2025, what that tells me is, we're still going to see tech outperform, and we're not really going to see a broadening out, which is something that has been a question as the Fed entered its cutting cycle. As I think there was a lot of the market that was looking for, outperformance of small caps or outperformance of even some parts of value. And really what this tells us and what we learned from the Fed yesterday is, we're probably not going to see that broadening out, and we really need to stick with high quality growth.
Do you agree with that, Michael, that we'll likely see this concentration within the markets play out?
I think in the near term, the reaction is oriented around that positioning. To us, the balance of the year, I think, is going to play out dependent upon the incoming data. So what we're thinking is just a few months ago, the mindset of the Fed was we have to cut aggressively. And all of a sudden yesterday, they've moved from a coin flip to a 25 basis point cut and outlining to the marketplace that they're going to slow. So I think it's really going to be about the data. And our positioning is that in the near term, market volatility is going to be oriented around just the reaction to yesterday. But it's going to be the data and the incoming administration and their policy that's going to dictate 2025 and beyond.
Michael, sticking with you for a second, Torsten Slok this morning saying that there's about a 40% chance that in 2025 we could see the Fed hiking rates. If we do get that, what does that do to the market rally?
I think the mindset from Torsten, we've spent a lot of time with him, and I review his commentary all the time. It's on the back of a stronger macro environment. So if the economic environment dictates the need to cut in conjunction, or in the need to raise in conjunction with elevated inflation, I think the markets can react to that in a positive fashion, because that will also be indicative of a strong growth environment for corporate profitability.
Caleb, when it comes to we're finding those opportunities, you mentioned that we could see that outperformance in tech. I guess my my question then is, to what degree does that outperformance look like? Because here we are, we're not too far from some of those record highs. We have seen some buying opportunity. We have seen investors once again favor these names. How much more room is there to run in some of these market favorites?
That is the key question. I can tell you from what we see in our data, which a lot of it focuses more on those institutional investors. When we got to the starting point of 2024, the conversation was, okay, we're already overweight tech. Where do we go to next? And really what we've seen is that because the options elsewhere are not that attractive, you can also look at this from a regional perspective. If you're thinking of maybe it's time to move out of the US equity space to elsewhere, the answer is the US is still the best option. We still see high quality growth as the best option. And so because of that, because of the macro environment and the fundamental strength behind those parts of the market, you're probably still going to see positions increase, even though there's already overweight positioning. So really what that looks like, I think, from an overall equity perspective is that, yes, equity markets will still be okay, especially if what Michael was alluding to with stronger growth, maybe that means a higher neutral rate, and therefore that's the reason why rates can't fall as low as markets had expected before. That still creates a okay environment for equities. You're just not going to see that broadening out.
Kayla, are you at all worried just about the drama that's happening down in D.C.? We could potentially see a government shutdown, that's going to halt some of this momentum right here?
I think it could, but I think where you're going to see that play out more is in the rate space. And so really this ties back to looking at the potential for a bear steepener in 2025. And so we've seen, quite a bit of adjustment over the past 24 hours. I'd say on the long end, there's still room to run.
Okay, but given the policy positions moving forward here and the lack of clarity about them, Michael, I want to end on how you are pricing in the Fed's divergence when it comes to thinking about policy. We had heard Powell saying that they are not considering policy from the incoming administration, and then yesterday he said actually some Fed members are. How do you digest that decision from the Fed?
We've felt all along that the stance and the rhetoric is going to be to ignore the incoming administration, and it's going to be the data. So the two are ultimately the same. It's going to take some time. There's going to be uncertainty. We look at this as a strong opportunity. We've felt for the last several months that we're going to be in a higher for longer environment and regime. That's a net positive for investors because, to the earlier points, you don't have to go that far out on the curve because there's potential risk for higher rates. At the front end with limited duration exposure, you can capture really attractive income and yields, which I think will balance your overall portfolio.
All right, Michael and Caleb, thanks so much for taking the time to join us here this morning.
Thanks for having me.
Crypto making a grand return to the spotlight this year, with Bitcoin topping $100,000 for the very first time. And in that space comes Yahoo Finance's pick for comeback of the year. It's Robinhood. Yahoo Finance's executive editor, Brian Sazi, joining us now with more on why Robinhood comeback was noteworthy. I think you should just take a look at the stock price.
Well, the stock price chart almost ran out of room on Yahoo Finance. I mean, the shares are up 191% year to date. When I originally penned this story, now on the Yahoo Finance homepage, the stock was up more than 230% year to date. So big year for this company in terms of stock price. That is one reason why they won this award. Second thing is they are no longer a loss-making company. They have really swung to profits. It's because of the crypto business. They've cut a lot of headcount, a lot of other expenses out of the business, and it's a company serious about making money. And to that end, we had Vlad Tenev, co-founder and CEO, on Yahoo Finance to talk more about his company's big year and the product roadmap and the company's roadmap for next year. Take a listen. For people to understand what has happened to your business, we have to go back to some of those like lower points in the business for you, for as a leader in a business. I mean, what were those like, and how'd you get out of them?
I think 2022 was challenging, and 2021 when we went public actually had some stress as well. I remember when we entered the public markets. I mean, it was sort of at the height of the secular bull market, and we felt good, but the business now is much stronger across pretty much all dimensions. We have 9 business lines that are generating over 100 million in annual revenue. Business very diversified, growing across our main priorities of active trading, growing wallet share for the next generation.
Big year for the company stock price, big year for your company financially. This could be a really different company 10 years from now. Like, what is your vision for Robinhood?
I think the vision really is for anyone, anywhere in the world, whether you're an individual retail investor or an institution, Robinhood should be the best place for you to custody all of your financial assets and process all of your financial transactions. And so it's expanding across the 2 dimensions I mentioned earlier, going global, where we've got lots of winds blowing. The rest of the world is getting wealthier. It's going to the technological frontier. Mobile penetration continues to go up. Internet is becoming ubiquitous. There's multiple trends that are moving towards more self-directed, more focus on US products and US markets, and AI and cryptocurrency sort of booming at the same time. And Robinhood can really be at the center of these things and I think those are going to be the growth drivers in the financial industry over the next 10 years.
How happy are you that Gary Gensler's out the door and we have potentially this guy, Paul Atkins, who sure seems bullish or more bullish on crypto than Gensler?
Yeah, I mean, I think that Paul Atkins, we're very excited about him taking on the mantle and getting the agency pointed in the right direction again. I think the American public wants to know that regulation is here and that they have standard protections. There's good reasons for regulation in the first place. You want to avoid all the downsides and all the hard lessons we learned in the traditional financial markets that led to it in the first place. And we're very optimistic about that. And we're also looking forward to the end of the regulation by enforcement approach that has been bad for the industry, frankly, and bad for the public in the U.S.
If investors are trying to make sense of this move in Bitcoin and other cryptos, what do you think happens in the first year? What's the biggest unlock that you would like to see in the crypto industry from this administration?
Well, I think there will be a push for comprehensive crypto legislation. There's a stablecoin bill that got battered around a little bit, never made it to the Senate. That will probably be reproposed, maybe in a slightly different form. So there's talk of a Bitcoin strategic reserve, and I think if that happens,
what does that do to a business like Robinhood?
Well, we've been early to crypto, and we're one of the few public companies that actually has a large crypto business associated with it. So as the industry grows, I think Robinhood is well positioned to benefit from that.
When you look at the company, like how you made some comments on sports betting. I was trying to figure a way to ask it, but do you want to be that broad? I mean, are you going to go toe to toe with Yahoo Sports? I mean, what's your ambitions? Like, clarify that stuff for us.
I think that was taken a bit out of context. There was a question about the election product we rolled out. So we're going to broaden that. We're going to have a more expansive regulated events offering, and these are CFTC derivatives. So federally regulated. There's all kinds of contracts and events that are permissible that we'd want to allow people to trade.
Like if Taylor Swift starts her concert with this song, like that is an event.
Yeah, I mean, I don't want to get into specifics, but I mean, this is interesting to people because as sort of like the news goes more in the direction of entertainment, people are looking for information about what's actually happening right now. But if you looked at Robinhood on the election market and you saw Trump with a 95% chance of claiming the election, you sort of, that's the quickest way to distill all of the commentary.
Why are you betting so big on the desktop computer?
I think that if you think about an active trader, you want to be able to look at data and trade simultaneously, which we've innovated on mobile a little bit too, because we launched picture-in-picture. But yeah, you just need the screen real estate. And for us, active traders, it's almost like the Tesla Roadster. Specialized market, limited number of people, but they're the ones that really care about performance and latency. And so serving that customer base, besides kind of being the core, will help establish the brand of Robinhood as the place to be and the product to use if you want to be at the frontier of technology and innovation and trading.
Do you have ambitions or view that you want Robinhood to be this generation's JP Morgan?
Well, one of the things we care about, this is the second arc, our 5-year arc, what we call it, to be the leader in wallet share for the next generation. And right now, Robinhood has more millennial and Gen Z customers than the leading
50%
brokerages.
millennials?
Yeah, millennial penetration and Gen Z is even higher, actually. So we see an opportunity to help them with all of their financial needs with an emphasis on multi-generational needs. So we want to serve their parents, their kids, and I think that's something that the existing industry players don't get right. Nobody has a great kind of like family, multi-generational experience. And I think there's low-hanging fruit there. If we serve the whole family and really have a great integrated experience, which our recent acquisition of Trade PMR should help facilitate, I think Robinhood can be the place where, you actually like stick with.
All right, so maybe you will be able to bet on that first song from Taylor Swift at a conference at some point over at Robinhood in the next decade. But really, guys, what you can't maybe necessarily see every time the company reports earnings is the change, I think, in leadership for Vlad. I've gotten to spend a good amount of time with him in recent years, and I sense and I feel that he has evolved as a leader. He's gotten serious about expense cuts. He's gotten more serious about new product development. And I think he's just become a better leader. Now, no leader is perfect, but I think he's just operating the company a lot differently and more like a public company that has to do good for shareholders and all constituents involved as compared to when they first went public a couple of years ago.
Certainly experience definitely helping, and that's also reflected, one of the reasons reflected in the share price here that we have seen this
Well, what's your favorite Taylor Swift song? You just love all of them,
Ready
Shauna.
for it, I really
Just curious.
I don't know.
I hope you bet on that. Maybe someday on Robin, you could bet on Shauna Smith's favorite
I don't know,
Taylor
I don't know
Swift
if that
song.
would be at the first song.
Okay.
Yeah, I know. I'd have to, yeah.
She's got too many to name. Yeah.
All right, Saz, thanks. Tune in to Yahoo Finance 4:30 p.m. Eastern Time tomorrow. It's a special look at all of our 2024 awards. Brian Sazi and the team has been working extremely hard for the lineup here this week. So again, you can catch that in the special tomorrow. That's all at 4:30 p.m. Eastern Time tomorrow afternoon. Well, coming up, the clock ticking for Congress to pass a funding bill and avoid a government shutdown. Where our next guest saying that this was just a preview of what's to come in 2025 on the Hill. We've got that for you coming up on Catalysts.
government shutdown looming as Congress battles over a spending bill. President-elect Donald Trump urging Republicans to reject that bill. A measure put forth by House Speaker Mike Johnson would have funded the government through mid-March. That measure included disaster aid, healthcare policy extensions, and a pay raise for lawmakers. But Trump pushing for a streamlined spending bill and called for the abolishing of the debt ceiling in a phone interview with NBC this morning. Joining us now with more, we've got Brian Gardner, Stifel's Chief Washington Policy Strategist. Brian, great to have you here. So in your notes, you said you still think the odds of a shutdown are low. Do you still feel that way?
Yeah, kind of tacking on to Brian Sazzi's interview with Vlad, I think we can, put up something where, betting on Robinhood, whether the government's going to shut down and whether the debt ceiling is going to go away. I think the odds of a shutdown are still relatively low. It doesn't look good right now because there's dysfunction, there's disagreement, a deal has fallen apart, and so it's tough to see the end game. I think what will happen over the next couple of days, probably getting us into early 25, is a series of short-term extensions without an actual shutdown. So, yeah, it doesn't look great right now, but I think a shutdown is not my base case scenario. Government remaining open is.
Brian, why are you confident that we will reach some sort of extension?
Because no one wants a shutdown. There's a lot of disagreement up on the Hill about what the pathway forward is. But going into the holidays, no one wants the optics of shutting down the government. And there will be people out there who say it's not a big deal. And I would say for markets, it's not a big deal. We can get into that separately. But it's not a big deal for the country. We can get through it. It doesn't impact the economy. We're going into the holidays where there are going to be federal workers, and those include troops, who don't get paid for a couple weeks. And so the optics of a young Marine Corps enlisted man or woman who has, a spouse and kids and having trouble paying bills at the holidays is just a very bad optic for Washington. So I think the default will be keep the negotiations going. If they have to extend government spending for a week, they'll do it. They'll just keep kicking the can down the road until they eventually can get to a deal that lasts a longer period of time, whether that's March, whether it's even longer into the fiscal year.
What is the nature of the conversation from the likes of President-elect Trump, but also Elon Musk on X telling people to call their representatives? What does that tell you about the dynamic that voters can expect to see and investors can expect to see in the 4 years ahead in this Trump administration?
We have been through efforts in the past to reduce government spending, to make government more efficient. The Reagan administration did it. The Clinton administration did it. But those efforts occurred in an era pre-social media, pre-internet. And I think with the Doge, what you have is two individuals who are very charismatic, very present on social media, and are able to drive the conversation nationally. Facts don't always play into the calculus. I mean, there were some misrepresentations about the substance of the bill that's not going to pass, but that's secondary. It drives the conversation, and so lawmakers are going to have to be very careful to avoid potential landmines that are going to be all over the battlefield, the political battlefield in the coming year regarding spending and just the general way the government operates.
When you take a look at how much pressure House Speaker Mike Johnson is under, lots of questions about whether or not he's going to be able to remain in his position, what that's going to look like here under the Trump administration. What's your base case there?
It's a toss-up at this point. Johnson was going into the spending debate in a precarious position just because of vote math, right? Republicans are going to start the year with a 219, 215 majority. The speaker needs to be elected on the House floor. He needs 218 votes, so Johnson can only lose one vote. And we have seen this play out in January of 2023 and October of 2023 when Johnson replaced then Speaker McCarthy. You already have one Republican, Tom Massey of Kentucky, who said he's going to vote for somebody else. So we're at 218. That means Johnson cannot lose anybody else. And my gut tells me, without knowing anything specific, my gut tells me there are other House Republicans who are going to vote for somebody else or against Johnson. And he's going to fail to get 218. and we're going to go through a couple of rounds in the first weekend of January, just like we did 2 years ago, trying to figure out a speaker. And then it really, because Trump is the incoming president, it's going to be up to him, I think, to actually choose somebody and get Republicans to fall in line behind his pick for speaker.
Final minute, Brian. You mentioned the market doesn't really care about the shutdown, but they certainly care about the Fed signaling fewer rate cuts to come in 2025. That's what led the sell-off. How likely do you think it is that Trump is going to increase his threats against Fed Chair Jay Powell if we do continue to see pressure in the market as he enters the White House?
You know, so he's been back and forth on this, right? During his first term, he threatened to fire Powell. He's backed away from it more recently. I think over a fear that it could upset the markets. But yesterday we had 1,100 point sell-off in the Dow, and there's nothing that Trump wants to see less than the markets reversing themselves and selling off as a signal of potential weakness or lack of confidence in the government that's coming in. And I think that increases the chances that Trump will once again pivot and threaten Jay Powell's job. Now, we can get into why I don't think there's a great chance that he is actually going to be removed. There are legal issues here that I don't want to bore your watchers to death with. So I'm skeptical that he's actually going to be removed. But I think the odds of a Trump threat to fire Powell in the wake of yesterday's Fed announcement and the market reaction to that announcement have increased materially.
All right, Brian, always great to get your insight. Thanks so much for taking the time to join us.
Thank you, guys.
Coming up, we're going to dig into the Fed's path forward with former St. Louis Fed President Jim Bullard. He joins us on Yahoo Finance next.
I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability.
That was Fed Chair Jay Powell giving the reasoning behind the FOMC's decision to cut rates by 25 basis points, saying it was, quote, the right call. But not everyone agreed. Cleveland Fed President Beth Hammack was the lone dissenter on the decision, saying that she preferred to hold rates steady. Here with more, we want to bring in Jim Bullard. He is the former St. Louis Fed president and current dean of the Mitch Daniels School of Business at Purdue University. Jim, it's great to have you back here on Yahoo Finance. The perfect day to talk to you, so thanks so much for making the time to join us here.
Happy to be here.
So let's talk a lot to get into. We want to get into that dissent in just a second. But first, I just want to start with the tone that we heard from Powell, because that was clearly the driving factor in the markets yesterday. We're seeing a bit of a bounce back here this morning. But I'm curious what your big takeaway from the tone that we heard from Powell, and maybe what this signals just in terms of where the Fed is going to stand 12 months from now.
Yeah, I mean, the committee cut the policy rate by 25 basis points, but make no mistake, this was a hawkish decision, sometimes called a hawkish reduction in rates, where the path of rates was revised up, and so markets saw less aggressive policy easing during 2025 than they were previously expecting. You got a pretty marked reaction in both bonds and stocks, and so I think that's what's going on here. I don't think markets should have been quite as surprised as they were. I thought that a lot would hinge on the SEP, and it did, and so you did get a reaction.
Well, it's interesting because I know yesterday you said that the dot plot would do the Fed's job for them, but it sort of just added to questions about divergence on the Federal Reserve, potentially for dissenters at this meeting. How deeply divided is this Fed?
I think the for dissent interpretation is reasonable. If you look at the dot plot, obviously some did not think they should have lowered at this meeting. We'll hear more as the blackout period ends and people come out and talk about their views, maybe over the holidays or the first part of next year. So I do think that, and the chair said it was a closer call, but they wanted to go ahead with this 25 basis points. I actually think it does get them at about the right level for this situation of the policy rate, given that inflation has been a little bit sticky, so they're not going to be able to move as fast during 2025, certainly not as fast as they've moved in the last three meetings. They had a 100 basis point decline last three meetings. It's going to be nothing like that in 2025, but I think it jolted markets a little bit because now it looks like there may be a pause for a couple meetings.
Jim, what do you think the neutral rate should be?
The committee thinks the neutral rate is 3%, but then you have to add about 100 basis points on that for the fact that inflation is still above target. So you still want to be restrictive. You still want to be putting downward pressure on inflation. So that would get you to a number more like, 4% would be the right level of the policy rate. You could tweak that a little bit and get 4.25. So the committee's, getting right in the range of where they should be, I think, for this environment. That's why I think this is a pretty good decision and pretty good projection out into the future. I mean, you did get a sell-off in the market, but, that was the market sort of misinterpreting, I think, a little bit how hawkish the Fed would need to be to get inflation back down to target.
What can the Fed do to close that information gap? You've mentioned it a couple of times, Jim, the idea of the market sell-off being driven by a lack of clarity for investors. And this is what investors have told us this morning about the Fed's path forward. What could the Fed do to increase the clarity for the market moving forward about how they're going to make decisions about these rate cuts to come?
Yeah, I mean, I think the Fed does as best it can, but there's so much hair splitting around all the data and all the different arguments. I actually think it's a good thing that you have a lot of big committee and they can speak and give their different views and outline how they're interpreting all the various issues. And, it's a job to try to aggregate all that into a decision that the committee's making. But I think that constant communication is actually a good thing. And you did get some adjustment yesterday, maybe some recovery today, but I think it brings the market and the Fed in better alignment with what's going to have to be the policy in 2025 if you're going to continue to get inflation to come to 2%.
Jim, let's talk about what 2025 is going to look like. We're going to have President-elect Trump back in the White House. Lots of discussions, some questions yesterday that Powell was fielding just in terms of the policy implications, what that means for the Fed going forward. He was very much brushed off any sort of concern, I think, or just in terms of how big of a factor some of the tariffs are going to be here when it comes to the inflation picture, at least in terms of the Fed's calculations. How big of a factor do you see that being at this point?
I was on the committee in Trump's first term, and I didn't really see inflationary developments coming from trade. So I don't think those effects are actually very big. Of course, you can make them big if you think there's really going to be a lot of tariffs globally. But in that situation, I think probably the detriment to the world economy would outweigh any price effects. So I'm not really seeing the inflation argument here on tariffs. I think one of the biggest issues in 2018 and 2019 was that the trade war created uncertainty globally about what the rules were going to be going forward. And that then fed into investment. I mean, who wants to make $1 billion investment if you're not sure what the trade arrangements are going to be? So that happened in 2018, 2019, and in 2019, and I argued in favor of this, that the Fed should lower rates in response to that. So I think we'll see how it plays out this time, but I'm not really seeing this inflation argument.
When you were in the Fed under Trump, how much did you take policy proposals into account in your decision making versus waiting for that policy to actually be enacted? Because that's something else that came up yesterday, the idea that there are some members that are pre-thinking what the policy impact could be.
Well, you're trying to forecast and you're trying to take everything into account, not just the U.S. policy arrangements in the 2 years ahead or so, but also the global environment, geopolitical risk, all kinds of things. I think the reason policy changes get discounted is that some of them require congressional approval. Those tend to have low probability, no matter what the count is. And I think some things are going to happen this time. So you have to try to take that into account as best you can. Usually it doesn't have a huge impact on GDP or other real variables. One that did have a big impact in 2017, 2018, I think, was the corporate tax change. And that was anticipated by markets correctly. And it did pass. And I think it was for the better. And it did increase U.S. GDP. So I think actually that was one that as we went through 2017, I argued that we needed to take that on board in our forecasts.
Jim, real quick before we let you go, we would be remiss not to ask you about the potential here for the destabilizing relationship that we could see between President-elect Trump and Powell and other members here of the Fed. I'm curious what you think the market or investors need to keep most in mind when it comes to some of that back and forth, or maybe just more so from the Trump administration, some of the criticism that we could hear of the Fed in the coming months.
I'm sure you'll hear some criticism at times. The administration will have a chance to put a new chair in place. The Treasury nominee has said that they would just wait for that process to play out. So that's what I'm expecting to happen here. But certainly the president has a prerogative to comment on monetary policy if he so desires. We have many other politicians in Washington, including in the Senate and the House, and they feel free to comment on monetary policy. So that's part of the give and take, I think, inside the Beltway.
All right, Jim Bullard, former St. Louis Fed president, thanks so much for making time for us this morning. We appreciate it.
Sure. Thanks for having me.
And as markets try to recover from yesterday's sell-off, we're going to dive into how you should position your portfolio for increased volatility to come. That's next on Catalysts. Volatility Index, the VIX, spiking to 58 yesterday afternoon after hitting its highest level since August in the wake of Fed Chair Powell's press conference. For his thoughts on how investors should be positioning in a more volatile market, I want to bring in Willem Sells, HSBC's Global Private Banking and Wealth Global CIO. And Willem, just to clarify, the VIX actually hitting 28 yesterday prior to seeing some of that volatility coming out of the market today here. You say that investors need to maintain an active strategy in a market with this much volatility. What does that look like?
Well, to a very large extent, this is obviously because we are going to go through a period where you have lots of policy announcements and therefore then people trying to assess what is going to be the impact on the economy, on inflation, and therefore on the Fed policy as well. So there are lots of things which we simply cannot predict. And therefore that leads to volatility, which you can see even already from yesterday. Volatility spikes don't tend to last very long. So, investors can take advantage of that by selling that volatility when it spikes. Other things that people can do is indeed, as you said, an active approach, because, if we cannot predict certain things, people can adjust their positioning when, for example, your yield curve steepens or flattens, when your interest rates go up or down, when your currencies move and so on, and tactically take advantage of that. So they can do that directly, or obviously through, fund managers that are very active, or even in the hedge fund space through long-short strategies.
Well, is there any fear from this, as you take a look at the spike in the VIX yesterday, that's longer term, or is it very much a short-term sort of risk that is being evaluated?
So when we're talking about equities, we need to think about, what is also causing the volatility in the interest rate space. This is to a very large extent because we already have a quite strong U.S. economy, and at the same time, we potentially get further stimulus either through deregulation or through tax breaks. So in the equity market space, you have the positive side and the negative side together. That earnings growth, that we are seeing because of that resilient economy, plus, everything that is to do with deregulation, with innovation, with government policies, that creates a very broad opportunity set. So I do think there are a lot of opportunities in the equity market, where companies are going to do much better than the very low earnings expectations that analysts have penciled in. So yes, to your question, those opportunities will materialize, and therefore, I rather see volatility as an opportunity.
You mentioned you anticipate more growth to come in the U.S. Given that you also anticipate more growth for the dollar, how much pressure does that put on the rest of the world? And does that set us up for a higher than not likelihood of a growth shock heading into 2025?
So the U.S. is the main engine of positive news in terms of economic growth, and that is in part what drives the U.S. dollar. It's those opportunities that are going to lead to investment inflows into U.S. markets, but it's also obviously the interest rate differential. If the Fed is slower at cutting rates, but the ECB continues to cut rates in the eurozone, then you have that attraction for the dollar. So indeed, we do expect a strong dollar. Eurozone equities have slightly benefited from that weaker euro, but I don't know about your clients, but quite often retail clients don't hedge their currency exposure. So we don't tend to see strength in the equity market that is led by currency weakness, as is the case in the eurozone, at a positive, because what they may gain on the index level, they may lose on the currency level. So we very much have that preference for the US. We try to diversify a little bit with UK stocks and Japanese stocks, as well as Indian stocks.
Willem Sells of HSBC, thanks so much for taking the time to join us. Coming up, we're speaking to Senator Cynthia Lummis about the potential for a U.S. crypto reserve. That and more coming up next on Yahoo Finance. Bitcoin and other cryptocurrencies trading lower here today after Fed Chair Jay Powell appeared to shut down a question about the government possibly building a Bitcoin strategic reserve. Let's listen.
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
President-elect Trump has backed such a reserve, and investors are very bullish on Trump's pro-crypto stance. Our next guest calling 2025, quote, the year for Bitcoin and digital assets. Joining me now, we want to bring in Republican Senator Cynthia Lummis of Wyoming. Senator, it's great to have you. Thank you so much for taking the time to join us here this morning. So let's start with the commentary that we got from Powell yesterday, just because that is such a driving force here in the markets this morning. The market seems to be a bit worried just about maybe what we heard from Powell, what that could signal here for crypto adoption going forward. Does that at all derail some of that optimistic sentiment that we have heard from you and your colleagues on the heels about Bitcoin and what that adoption rate could look like?
It doesn't discourage me, because what Chairman Powell was saying is they don't have the authority now to own Bitcoin. I want to give it to them. I want our federal government to have a strategic Bitcoin reserve that can help back the U.S. dollar as the world reserve currency, and then serve as a long-term savings account, thereby offsetting our national debt, which is over $36 trillion now. So my proposal would have the U.S. Purchase through other assets it already owns 200,000 Bitcoin a year for 5 years for a total of $1 million, hold it for at least 20 years. And at the numbers that we project, that would accrue a fund that's worth about $16 trillion. So it has a couple of benefits for our country. As I said, shoring up with a hard asset, Bitcoin, our U.S. dollar, and it helps offset some of the pain of our dramatic national debt. Now, if you were to see Elon Musk and Vivek Ramaswamy's Doge effort goal reduce our expenditures, we would be able to bring in line our expenditures in a way that flatlines our debt and allows us to begin to retire it.
So, Senator, just curious, if it was that easy to convert these certificates that Federal Reserve banks across the country already have into Bitcoin to cut our deficit, why has nobody at the Fed thought about this previously? They've had these reserves since the 70s.
Because, as Chairman Powell said, they don't believe they have the legal authority to own Bitcoin. We need to give that to them. The Bitcoin the U.S. already owns, roughly 200,000 Bitcoin, are within the asset forfeiture fund. And it's important, I think, that we take that fund, scoop it over into a strategic Bitcoin reserve, and then add to it, which is...
Is Bitcoin the right asset class to do that, even if that authority is given, just because of the volatility of it and also the fact that it's only been around for 15 years?
It absolutely is the right asset. It is digital gold. It is a finite source. Only 21 million Bitcoin will ever be mined. And it has the elements of strength. And even though it's slightly volatile, it's always volatile in an upward leaning direction. And so the goal here of holding it for 20 years is in recognition that on the short term, there is short-term volatility. On the long term, there is long-term growth that far exceeds the ability of the U.S. dollar to keep up. The U.S. dollar is designed to debase. The Fed has a goal of 2% per year inflation, whereas Bitcoin's goal is to far exceed in value inflation and far exceed the value of the U.S. dollar. And so far from inception, it has done exactly that. It's grown about 55% per year if you look at the long term. Over time, it'll drop from 55% a year to 45% a year to 35% a year. But it will continue to grow, where the US dollar will continue to decline in value. So it's a very important asset to hold.
Senator Lomas, while we have you, only have a minute left here, but I want to get to some of the dysfunction or disagreement, maybe is a better word to call it, inside the Republican Party on the House side. And I bring that up just because of some of the names and scenarios that are being floated, whether or not Mike Johnson is the right person for the speakership. We had Rand Paul out this morning floating Elon Musk potentially as a speaker. What do you think of that?
I love Elon Musk at Doge. I love Elon Musk and his close relationship to President Trump. I think that's where you're going to see the thought leaders, the most inventive people in the world working together to solve problems. I think if you put Elon Musk in as a speaker substitute, it's a total waste of Elon Musk's extraordinary talent. Elon Musk shouldn't be used to try to corral consensus within the House. That's a skill set that Mike Johnson has. Elon Musk is an out-of-the-box thinker. You don't want to limit his out-of-the-box thinking by putting him in the U.S. House of Representatives to lead it.
All right, Senator Lomas, we got to leave it there. Thank you so much for joining us this morning. We appreciate it.
It's been my pleasure. Thank you.
Coming up, we've got Wealth dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we'll zoom in on the stock market and how investors should think about their portfolio during a sell-off like the one we saw on Wednesday as the Fed signaled a slower pace of rate cuts in 2025. And the Fed did reduce rates by an additional 25 basis points. We'll discuss what the move means for your money, from your credit cards to mortgages and even student loans. Plus, there is a looming government shutdown. Funding will run out at 12:01 a.m. Eastern Time Saturday unless Congress takes action. We'll break down how a potential shutdown could affect you and your benefits as well. All that and much more coming up during today's show. But first, let's begin as we always do, 90 minutes into the trading day here. Stocks right now in the green. This is after a steep sell-off on Wednesday. That was triggered by a hawkish pivot from the Fed, signaling fewer rate cuts than expected to come in 2025 and leaving a possible hike on the table. Yeah, you heard that right. Joining me now is Justin Haywood, Haywood Wealth Management President and co-founder. Great to have you here with us today. Help us make some sense of this. What's the best way to manage your positioning following a steep sell-off like the one we saw on Wednesday?
Yeah, it was, I think, a little unexpected with the magnitude of the sell-off. I would call yesterday's move a hawkish cut. I think the Fed was probably reluctant to make this cut. They may have backed themselves into a corner in a sense with their rhetoric in September, and I think they felt like they needed to make this cut, but they were reluctant to do so. So I would view this as a hawkish cut. As far as your portfolio positioning, it was just last week that we were talking about S&P 7,000 at the end of 2025. Obviously, with a lot of policy uncertainty with the Trump administration, I think that overall, still the sentiment should be relatively bullish. But you want to ride this out. And again, just last week we were talking about S&P 7,000 potentially.
Let's talk about some of your picks kind of going into and navigating an environment with a hawkish cut that we've seen, and now with the positioning that the Fed has put into the markets, at least as they look out to 2025 here. Which sectors do you believe are best positioned here? As it seems like from one of our discussions earlier today, the new defensive play might actually be technology.
Yeah, that's exactly right. Technology continues to lead the way. They remain very profitable, and as long as they continue to turn profits, I think technology. It is interesting that you look at something like Apple, the way that they are able to generate cash on a relatively predictable basis is mind-boggling. Also, I think there's a lot of momentum behind it. It's hard to ignore the momentum behind Tesla and Elon's relationship to Trump. So I do think that if you're just trying to ride a wave of momentum, Tesla and some of the other stocks like Palantir would be strong momentum plays. Now there's a lot of volatility there, so you want to be careful with positioning, but technology remains a strong play moving into 2025.
Certainly. I wonder, with all of the deregulation talk that certainly could have some lighter fluid on it going into the start of 2025, and with the new regime change that's taking place in Washington as well, how deregulation also impacts some of your sector picks. And from what we've heard thus far, it seems like financials is one of the leaders in that realm of mind as well.
Yeah, as far as deregulation, I think that we've seen M&A activity, a lot more buzz around M&A. Financials have obviously done extremely well in 2024. You could look at it that they're overextended, but with potential deregulation, I think there's a lot of continued momentum in the financial sector. But yeah, I think that you're going to see a much more dovish antitrust environment, which is going to lend itself to a lot more M&A activity in the coming years.
And so with that in mind, as you're thinking out to 2025 and already kind of putting together some of the aggregate earnings growth estimates here, what are your anticipations for where companies will continue to show the street that they can grow, putting the Fed aside, putting geopolitical concerns aside here, and really kind of delivering on their own growth forecasts?
Yeah, I think that the continued adoption of AI is creating a lot of efficiencies within the corporate environment. I think that as you continue to see corporations adopt AI into their systems and integrate things, that will feed into bottom line earnings growth into 2025 and beyond.
Justin, thanks so much for taking the time here with us this morning. Certainly do appreciate it.
Thanks, Brad.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up here, we got to take a look at shares of Darden Restaurants. They are surging today, up 13.5%. After beating estimates in its most recent quarter and raising its full year sales guidance. Now, Olive Garden and Longhorn Steakhouse, they both saw higher than expected same-store sales growth. Promotions like Olive Garden's never-ending Pasta Bowl, they offset some of the weakness in Darden's fine dining offerings. On the other hand, Conagra Brands ticking lower after cutting its guidance. The company cites sticky inflation and unfavorable foreign exchange rates as headwinds. The snack maker also seeing an increased promotional environment as consumers continue to seek value and prioritize affordability. Speaking of value and affordability, well, Dollar Tree, they're naming a new CEO. Michael Creedon is going to be the permanent CEO after taking on the role on an interim basis last month when the previous CEO stepped down. Now, Creedon will steer the company's turnaround as Dollar Tree and its competitors have struggled with a slowing consumer and increased promotional environment. Another trending ticker to watch this morning, used car retailer CarMax beating on the top and bottom line in the third quarter. Used vehicle sales, they climbed 1.2% from the prior year. And we're seeing some positive reaction in the stock. Here with more reaction, we've got David Whiston, who is the senior U.S. Autos equity analyst over at Morningstar. Great to have you here with us. So just as we're thinking about the car buying market right now and what CarMax is signaling, what type of permeation of momentum are you expecting going into 2025?
Basically, CarMax and all used car retailers are battling the aftermath of the chip shortage that decimated new vehicle production, but that ultimately impacts used vehicles supply and drove pricing up and made affordability horrible for everybody, including the retailers. So what's been going on is that whole process slowly unwinding, and ASPs for CarMax continue to come down, and that's actually a good thing because it helps not only consumer affordability, but it helps inventory procurement affordability, and you really saw that take off today. Hopefully that should keep going over time. It's really just math and time. And I've been telling clients for a while, just if you're willing to wait this out, I think you'll be rewarded buying this stock well below 100 share. And that's today is luckily is a good day for that.
You know, I wonder, and what we're hearing from the company as well, even beyond the buying of vehicles, they bought 270,000 vehicles from consumers and dealers in the quarter. That was up actually just shy of 8% compared to last year's third quarter. And ultimately here, where they're moving through that inventory that they're buying here, at what margin rate are you anticipating that they'll be able to kind of appreciate, well, at least perhaps increase their margin rate over the course of getting rid of some of that inventory as they sell through?
What's going on is building up for tax refund season, which is a big time, a peak time really for used car retailers. That's coming in a few months. And I think to your question too, a lot of us who cover the stock, I think we think of it in terms of the unit comps, the same store unit comps. Where do those have to be to start really getting good leverage while keeping pricing healthy? And what CarMax has been very good at is keeping their gross profit dollars per unit steady in all sorts of environments. Recessions, expansions, it's always around $2,100 to $2,300 a unit, and that continues. What we're starting to see more though, some improvement in the used car comps like we did this quarter, and on a dollar basis, it was actually positive for used retail comparable dollars for the first time since second quarter of fiscal 23, I believe.
You know, it's interesting. I was comparing what we were hearing from CarMax with some data that J.D. Power had just put out as well this morning, talking about the automotive forecast for December 2024 and what they're expecting to see here as well. Retail sales, though, of new vehicles expected to see a nearly 12% increase versus December 2023. You hear a stat like that, what does that hold for the Carvanas of the world, the CarMaxes of the world?
think if people are interested in buying a car, even if it's, I know you were talking about new, but I think it's ultimately good for the whole economy because more new car sales, a lot of those customers will have a trade-in, and then that trade-in can be very often it's retailed either by the dealer taking it in, or if they don't want it, they wholesale it and it ends up with a CarMax, a Carvana, or your local used car lot, whatever it may be, and so you get more supply that ultimately helps affordability. It's a gradual process. So right now we're actually in the very bottom of off lease compared to 3 years ago because of the chip shortage. New vehicle inventory bottomed in September of 2021. So things are going to stay lean for a while in terms of availability. But CarMax has a real advantage over everyone else because they've got nearly 250 stores. They own Edmunds, and they have all these brick and mortar stores too that can take in vehicles either directly from the consumer online or at the store or online, as you noted, with 270-some-thousand vehicles. So they've got a lot of tentacles that some of their competitors don't have.
Just lastly, while we have you here, I was taking a look at some data from Carvana, and they were talking about the top-selling vehicles, used vehicles of 2024. The Tesla Model 3, Chevrolet Equinox, Nissan Rogue, and I won't go down the list of the other 10 here, but you think about those three vehicles that are taking the top spots here, and the continuity of that, what does that tell us about where consumers are perhaps coming around even more so to electric vehicles or looking for more hybrid options even?
Regardless of the powertrain, people want a good value. They want affordability. And, a used Model 3, obviously, it'll be less than paying top dollar for a brand new one. Tesla's pricing can sometimes be all over the place, up or down. But with used, there's a little bit of a slight contrast between new. Like in new, it's all about light truck. It's 80% is crossovers, pickups, minivans, SUV. So you have some consumers who actually still want or are only able to afford, say, a compact sedan, think Corolla, Civic. But instead of going new, they're buying used. So whether it's EVs or ICE or anything in between, it's all about value.
All right. Thanks so much for taking the time here with us, David Whiston. Appreciate it.
Thank you.
Let's do a quick check of the markets as we are taking a look at the major averages here, looking for a bit more of a rebound to try and erase or cut into some of these steeper losses that we'd seen yesterday. But we do have some gains here on the board, fractionally as they may be. For the Dow, up by about 0.3%, the S&P 500 up 0.4%, and the tech-heavy Nasdaq, you're seeing that up by about 0.3%. We'll round that up to as well. Coming up, how rate cuts will impact your money from credit cards to mortgages. Stay tuned. U.S. government will shut down at 1 minute past midnight Saturday without action from Congress. A government shutdown occurs when Congress fails to enact annual appropriation bills. When that happens, federal agencies must stop all non-essential functions until Congress acts. In this case, lawmakers were hoping to pass a continuing resolution, which would have kept the government funded temporarily. If the government does shut down, here's how it impacts your money. Retirees will still get Social Security checks, and Medicare and Medicaid programs are also protected. The Supplemental Nutritional Assistance Program, also known as SNAP, can continue if funding is not shut for an extended period of time, but under a tight budget, special supplemental nutrition program for women, infants, and children may be vulnerable. Now, in terms of travel, airport staff are generally considered essential, but you should be prepared for potential delays and slower wait times at the airport. And government paychecks can be affected. Non-essential federal employees won't be paid until the government reopens. Military members would not be paid, but benefits and VA hospitals would be unaffected. Now, post offices and other federal courts would remain open. The IRS still collects payments, but may have reduced staff to process those payments. Finally, a shutdown can have a major impact on student loan borrowers. The government may temporarily lay off employees, including from the Department of Education, and fewer employees can make it difficult to ask questions or resolve issues related to your loans. Affected areas include review of grant applications and awarding of grant funds. The Fed cut rates by 25 basis points. But what does that even mean for your money? Well, Yahoo Finance's own Molly Moorhead is here to break it all down. So Molly, how will this latest decision impact consumers?
Hey, Brad. When the Fed makes a move like this, we don't see an immediate direct impact in our various types of accounts. It's more of a trickle down. So starting with savings accounts, the interest rates that banks pay on our savings will come down as the Fed cuts rates. And so, while rates were really high, savings accounts were paying upward of 5%. It was great. But as they've been lowering rates, those APYs are coming down, and they will continue to come down. So your best bet is to just shop around for the best account offering the best interest rate. And you're probably going to find that at a online bank with a high yield savings account.
Interesting.
Next, credit cards would be next. On the other end, the interest we pay on our debt, those rates have been crazy high, 25% in some cases. And unfortunately, we're not gonna see a big change there just because the Fed cut rates by a quarter point. So you're better off calling your credit card company and just asking them to lower your rate. Don't wait around for the Fed, especially if you're carrying a credit card balance. Ask for a lower rate. Anything you can do to help minimize the interest you're paying and get that balance paid off.
Lastly, Molly, we got to talk about mortgages. How is that anticipated to be impacted?
This is the weird one, right? The housing market's just in such a strange spot. And as the Fed lowers interest rates, we would expect to see mortgage rates come down, but it's just not a one-to-one relationship. And if you remember back in September when they first cut interest rates this cycle, mortgage rates went up. So there's just a lot of different factors that affect mortgage rates. And so it's things like home inventory is really low. That's keeping prices high. We have millions of people who have locked into a mortgage rate below 3% that they got, during the pandemic or before. And so they don't want to sell and they don't want to move. All of that is keeping the housing market kind of in this log jam. And unfortunately, with the Fed saying that there's likely to be probably more like 2 rate cuts next year instead of 4, that's going to also keep mortgage rates high. But again, the overall trend of lowering interest rates should help the mortgage market keep us below 7%, maybe into the low 6s next year.
Molly, thanks so much for breaking this down. Really appreciate it.
Thanks, Brad.
The Fed cut rates by another 25 basis points. So what does that mean for student loan borrowers? Here with more, we've got Betsy Mayotte, who is the president and founder of the Institute of Student Loan Advisors. Betsy, great to have you here with us. Can you explain what impact, if any, that rate cuts have on student loans?
Sure. This is going to impact people with private student loans more than people with federal student loans. Those people with private student loans, if they have a variable rate, they could see the interest rates on their existing loans drop. If they have a fixed rate, now might be a good time to look into refinancing those high interest private student loans and maybe get a lower rate, which of course would save them money in the long run and maybe even lower their monthly payment.
And so that starts to get into my next question. Is now a time for borrowers to try and refinance?
Well, that depends. 99.999% of the time, borrowers with federal student loans are advised that it's a terrible idea to refinance a federal student loan into a private. And that's because federal student loans have a lot of very unique benefits and safety nets that private loans don't have. And once you do refinance a federal into a private, there's no take backsies. But for borrowers with private student loans, it absolutely might be a good time to start looking around and seeing if you can get a lower rate by refinancing that private loan.
The Consumer Financial Protection Bureau released a report that described a range of what they call unlawful activities across the student loan industry. And the CFPB says that borrowers were misled about losing federal loan protections when they refinanced, private lenders wrongfully denied benefits, and schools would withhold transcripts or access to classes even in cases where there were unpaid loans. Those are just some of the activities the CFPB described. I wonder, within those findings, what your takeaways are and how people can make sure that they are protected against some of these illegal practices.
Yeah, I was really delighted to see that CFPB report shine a light on some of the things that I've also seen in the work that we do with student loan borrowers, especially, some private lenders are really good about making it clear about the loss of benefits for refinancing a federal loan. Others not so good. The best advice I can give to consumers is what I would give them if you're for any financial product, which is to do your research and read all the things. I know no one likes to read the fine print, but it's so important with something especially like a student loan.
President-elect Trump takes office in January. He's pledged to start this new Department of Government Efficiency. He's also talked about getting rid of the Department of Education. How would student loans be impacted by this?
Well, by the things that you're mentioning, not much. If the Department of Education were to go away, which is very unlikely, all that would mean is that the responsibility for managing federal student loans would move to a different agency. Almost everybody says that would be Treasury. It wouldn't change the terms and conditions of those loans. Any such changes to terms and conditions on federal student loans has to be done by Congress and is only prospective. They don't make retroactive changes to existing loans.
All right, Betsy, that's good to know. Thank you so much. We'll check back in the future. Appreciate it.
Sounds good.
Sticking with the world of higher education here, recent filings in a class action lawsuit claim that 17 elite colleges illegally colluded to use the wealth of students and their families to make financial aid decisions. A lawyer for the plaintiffs said that, quote, that illegal collusion resulted in the defendants providing far less aid to students that would have been provided in a free market. Joining me now to break down the claims is Catalyst co-host Madison Mills. Maddie, you've been all over this one. So this case originally filed in 2022. What were we able to find out this week?
Yeah, so a lot of details this week, and it's really telling when you get into some of the email evidence of what some of these admissions officers were saying about the applicants they were getting and the degree to which the wealth of certain students was the only thing that allowed those students to get into some of these elite universities. That is what is alleged in this case. Just to give a reminder here, 17 universities are involved in this suit, the likes of Brown, MIT, University of Pennsylvania, Notre Dame. You've got more names on your screen here, and these are among the most elite, considered by some to be the most elite universities in the country here. These universities are supposed to have need-blind admissions, meaning that they are not supposed to consider the financial needs of students who have applied. Now, the universities say that's only the case for low-income students. We're not supposed to penalize students who might need financial aid, but the lawsuit is about whether or not they are actually supposed to be need-blind on the opposite end of the spectrum and not consider the wealth or the donations of students and their families in in the admissions process. So what exactly did this look like in practice? I want to pull up a quote on screen here. This is from the university, this is from Notre Dame, and this is from one of the former admissions officers at Notre Dame. In an email back in 2012 said, quote, "We allowed high gifting or potential gifting to influence our choices much more this year than last year," and later went on to say, "I sure hope the wealthy next year raise a few more smart kids." That was in the context of the fact that within a group of wealthy students, over 75% of donor admissions needed special consideration to get in. So basically those students would not have made it into the university without the donations of their families here. I should wrap up by saying that 10 of the original 17 universities have already settled on these cases, paying over $280 million to plaintiffs. That is about $2,000 to each individual student. Some of these schools, like Johns Hopkins, are still in negotiations, and 6 are fighting the lawsuit. Those 6 utilizing that strategy I talked about, saying that they are need blind for low-income students, and hoping that that is enough to make their case.
Yeah, we should note that UPenn, MIT, and Georgetown have all denied using wealth in admissions. Just to round out our reporting here, Maddie, thanks so much for diving into this one. Really important. Coming up, everyone, your Yahoo Finance Market Update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We're 2 hours into the trading day and it's time for Yahoo Finance's Market Minute. Stocks attempting a comeback this morning from Wednesday's Fed-induced sell-off. Here are 3 trending headlines that we're watching today. Accenture shares jumping today after its Q1 fiscal year 2025 report topped expectations. The IT service firm is benefiting from businesses' growing demand to adopt generative AI tools. And crypto-related stocks that have been riding the Bitcoin rally to 100,000 volatile this morning, with more profit taking while long-term holders are staying the course. Plus, eagle-eyed viewers of BlackRock's Bitcoin Explainer spotted a disclaimer saying there's no guarantee Bitcoin's 21 million supply cap will not be changed. And Vertex Pharmaceuticals selling off today after phase 2 trials of their non-opioid painkiller barely improved outcomes more than the placebo. Vertex is still pressing ahead with phase 3 and hopes a new class of pain medication will help curb the opioid crisis. And that's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return. Owning a home is as American as apple pie and baseball, yet the promise of achieving the American white picket fence dream seems more elusive than ever. In 2024, the median price for a new home is $495,750, a price that's out of reach for 77% of US households, according to the National Association of Home Builders. The median household income, meanwhile, is $80,610, according to the Census Bureau, suggesting the gap between how much a house costs and how much one can afford remains wide. Even with that gap, experts say real estate prices vary widely by zip code, and there are still ways to achieve home ownership. So how much house can you afford? Here's how to figure that out.
The really obvious factor that affects housing affordability is the home price itself. But there are two other factors that are really important for housing affordability. One is the mortgage rate. The other major factor is, of course, incomes. So those are the three legs of the housing affordability stool.
Of course, affordability is a quality of life calculation, so only you ultimately get to determine what works best for your monthly expenses and budget. But determining how much house you can actually afford starts with some basic details that will help you figure out what your biggest and most important monthly cost should reasonably be. A key first step is to plug the following into a housing affordability calculator. Your household gross income, that's your annual pre-tax income. Your debt, think monthly payments on loans and credit cards. The down payment, a percentage of the purchase price of the house paid up front. The loan term, the duration of the loan. Interest rates, interest paid during the loan term, which can vary based on credit score and market conditions. Mortgage insurance protects lenders in case a borrower defaults. Property taxes, a variable cost paid to local governments based on the value of the home and the land it's on. And of course, closing costs. To start, identify your household's gross annual income and gather 3 months of bank statements to estimate your debt payments. Plug that into the calculator. For this example, let's use $100,000 as the gross annual household income, a bit more than the median, with monthly debt servicing payments of $500. Lenders assess the percentage of your monthly income that goes towards paying your debts, your debt-to-income ratio, to determine your financial health and ability to take on a mortgage.
A lot of people go with the 30% rule of thumb for the housing costs. That's keeping your housing costs to no more than 30% of your gross income. Anything in that range should be comfortable for most people, but like most rules of thumb, you should think about how it applies to you individually.
Next, estimate how much down payment you can comfortably afford. Your down payment is usually the largest upfront cost. For this example, we'll use $10,000. Next, consider the loan term. A 30-year fixed loan is the most popular, where the interest rate stays constant or fixed throughout the life of the loan. We'll use a 30-year fixed for our example. Your mortgage will be your largest ongoing monthly payment. All the information so far and market conditions factors into the interest rate the lender offers. We'll use an interest rate of 5.795% with monthly property taxes and private mortgage insurance of $375 and $100 respectively. With all this data plugged in, a recommended affordable home price for a household with $100,000 gross income comes out to $329,902, while the loan principal and interest is $1,875. The total monthly mortgage payment, which includes property taxes, homeowners insurance, and mortgage insurance, is $2,500. You can adjust the home price accordingly if you want to spend less and see how much financial strain could be added if you spend more than you can afford. One thing to also remember, you need to factor in those closing costs, between 2 and 6% of the home's total purchase price. It's important to note that buying a home is a transaction, while owning a home is an ongoing budgeting consideration beyond the monthly mortgage. Save 1% of your home's purchase price for repairs and maintenance, because that's on you too. And don't forget about property taxes.
Property taxes tend to go up over time as costs for government services rise. I think when people are looking ahead and trying to think about how their housing costs will change over the long run, using a percentage of the home's value when thinking about property taxes or insurance is a good way of accounting for that. It takes time and preparation to get into the housing market. So making those little steps to save and prepare now to get your finances in order, I think that those are the right steps to take. And then, of course, anything you can do to improve your income, whether that's focusing on your career or taking on a side hustle, can also help you realize that dream of homeownership sooner rather than later.
Existing home sales this morning posting the strongest year-over-year increase since June of 2021, up 6.1% year over year. That's according to the National Association of Realtors. NAR's chief economist Lawrence Yun saying that more buyers are entering the market thanks to continued job growth, housing inventory growth, and consumers getting used to a new normal of mortgage rates between 6 and 7%. Joining me now on this, we've got Skylar Olson. She is the chief economist over at Zillow Group. Skylar, great to have you on the program with us. Just want to get your read in on the existing home sales, which jumped month over month 4.8% in November here. And then ultimately, we take a look at the sales that accelerated 6.1% from a year ago, largest ever gain, as we mentioned, from June of 2021. How's that showing up in what you're seeing at Zillow?
Yeah, absolutely. Existing home sales more than matched our optimism for November's numbers. We did expect it to come in probably surprisingly high. I think this more than delivered. What we had been tracking was an elevated, maybe stronger momentum from new listings from existing homeowners, kind of filling up the shelves, adding to that inventory for buyers, and the strength of the economy, push buyers through in a make it work mode despite rising mortgage rates to deliver such a stunning showing.
And so with that in mind, what is the home buyer, who is the home buyer that's really driving this right now as you kind of look at the data and across generations?
Yeah, the home buyer right now is still kind of your classic millennial, but on older side than you think. The oldest millennials are now approaching their 40s. It is a much easier time right now, though, for folks that are moving with existing home equity because they're moving radically high home equity forward into their new house. That means that we're seeing still, I think, a surprisingly high share of first-time home buyers than you'd think because of the demographics. But it is more a time for your not necessarily move up, your downsizing mover or move over mover because of that home equity.
When we look across pricing right now, and look, I follow Zillow Going Wild on Instagram, and it's amazing to see some of these houses that get listed and with ridiculous features, but it makes you think, all right, so for the price per square foot that I'm paying, is it worth it? For a lot of people, they're running those calculations. They're using the Yahoo Finance calculators as well, trying to figure out what they're getting in the bang for their buck here. And affordability, we know that is just skyrocketed in terms of the pricing and the unaffordability, we should say, for many kind of historical metrics that we've been tracking. When do you expect affordability to improve more broadly?
Well, speaking to, I think, the strength behind the economy, home prices are going softly still, but still up, which means we're not going to see the big relief from a price correction. Any relief that we hope for from affordability will come in the form of lower mortgage rates after the FOMC meeting, after strong economic data. That becomes less likely. Zillow forecasting now has mortgage rates staying above 6% for all of 2025.
Okay, and so I want to get to some of the predictions that you've got for the housing market more broadly over at Zillow. Your predictions for 2025, what are they?
Yeah, well, thinking about the affordability challenge, but also thinking about the strength in the economy. So folks are definitely going to be looking for that opportunity. Put two of those things together and you've got a lot of buyers in make it work mode, which means where are they looking? They're still trying to take advantage of more affordable, say, exurban cities. So think beyond the core, where maybe it takes an hour and a half to get to the theater or some really rich amenities, but it's more affordable out in that smaller city. You also might have a return to living small in that way. We have started to see at least condo prices in the really small downtown areas stop falling. So a renewed interest maybe from the opportunity of prices having fallen or at least been much, much softer in the core. And then also, if we're thinking about the rental market, which will be more important next year because of the continued barriers to the for sale side, think about the generations of people who are going to be renting for longer. That means they're more likely to have kids. And these days, pets, 3 out of every 5 renters have pets. Knowing that from Zillow's surveys, feel free to try and demand that kind of amenity from your landlords moving forward.
I wonder what we're expecting to see as well in listings. The number of people who are sitting on homes because they're locked into a very low rate, but maybe they don't need that much home, or maybe they're looking at the market and saying, okay, if there are more buyers that seem like, even at this mortgage rate level, there is a propensity to need to get into a home or need to get a larger home, how that's going to impact some of your outlook on the listing side for the existing homes.
Yeah, given the higher mortgage rate environment, Zillow does expect probably fewer new listings from existing owners than we did just a couple months ago, moving in to that next year. That said, we still forecast a steady improvement. That's going to be particularly true with more new listings come in the lower half of the US. This past year, that was the case in Florida and Texas, where we saw buyers markets and rising inventory. We expect that to now start moving into the Southwest. For similar reasons that you think of, when I think of the lower half of the US, those are owners that are less locked into their mortgage. So they're less locked in when a major life event happens, like say they're ready to retire, move down, move up, more kids. They're more able to do so because that housing market is actually still functioning and moving with available listings. That will be more the case moving forward, I think, in more areas as inventories start to rise and buyers experience affordability challenges. So not everybody can move forward, right? Over time, I think we're going to have a softer housing market in 2025, but steadily going towards normal.
What's this mean for rents?
Rents turned up over the month. So in the same way that we kind of downsized our forecasts for home volumes in terms of sales and home price growth, we actually swung up a bit in terms of our expectations for rent growth. That's not just because of the long run mortgage rate situation. That's also from some of the momentum that we saw in rent over the past couple of months, kind of renewing its strength. We have been in a spot where rent has been slow growing. That's still the case because we've got a lot of new apartment buildings continuing to come online. Moving forward in the end of next year, those newly constructed units should start, we'll see fewer of them coming onto the market, right, each month. And then we might continue to see that rent growth coming. We saw early signs of that in November's numbers.
Skylar, thanks so much for taking the time here with us today. Really appreciate it.
Yeah, thanks so much.
Coming up, everyone, we'll examine the outlook for Americans' wallets in 2025 as a new poll shows more people are pledging to focus on their finances in the new year. Stay tuned. A programming note, in this week's episode of Money Glow Up, host Tiffany Alashay speaks to Ashley Fox, the founder and CEO of Empify, about developing an in-depth financial plan for yourself.
So I would tell individuals, pick your number. Don't pick the internet's number. Don't pick what I tell you. What is something that works for you? and commit to that. Open the account, set up the automatic deposit, and then start to do your research. And so I think we spend more time trying to pick the company we want and then try to figure out how, or if it's a certain amount of money, I can't afford it. We find all the reasons to create limitations when all you have to do is pick a number. And I would say at least start with $20. There are brokerage accounts that exist now that can allow you to invest with $20. Or if you have $100 and don't overstep, but put yourself in a position to gradually grow.
You can catch Money Glow Up every Thursday at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Well, with the new year just days away, yeah, you heard that right, Americans are pledging to focus more on their finances in 2025. And according to the 2025 New Year's resolution study from Allianz, 41% say they are more stressed than a year ago, almost exactly the same as the 40% who said that in 2023. Now, 38% are focusing in on financial stability. That's up from 33% last year. Good. I want to bring in David Chubak, who is the Edgar Jones Head of Branch Development and U.S. Business Unit. David, great to have you here with us in studio. Let's talk about this because you identified a few key financial themes in the new year. What are they?
Well, first, let's start with the simplest thing, especially after a day like yesterday. Stay calm.
Okay.
People put emotion into their finances, and it rarely ends well. So stay calm. Second, have a plan. Sounds real simple, but it's very difficult. People to think about how to put a plan together on spending, on savings, borrowing, and of course on their investing. Third, make sure that plan is thinking about multiple horizons. A lot of people focus on the here and now, the inflation, and they kind of avoid the the medium term. How to think about debt, how to think about housing, how to think about retirement. And then fourth, and this is most important, don't be afraid to ask for a little help. This is a tough area. Especially in a period where we're seeing that 41% of high anxiety. Go and ask someone for help. Go ask a professional because they can help you think through it.
And so if Americans want to make some changes to their finances this year, what are some of your top recommendations?
So first and foremost, again, is think about the here and now because, look, as we're ending the year, many people are looking at high markets, absent yesterday, are thinking of taking gains, are also thinking about tax impacts. And so think the here and now and make that plan and get that done now. Second, as you start the year, think about that plan on spending. Again, I just saw your segment on housing.
Yeah.
Housing costs remain high. Interest rates coming off yesterday, still looking like they're going to persist high. So you have inflation, you have rates, healthcare costs, aging parents. All these pieces together are leading to people have to rethink their initial ways of how they're going to spend money and therefore how they're going to save money. So you got to be thinking about how you plan that now. But also use that as a moment to be thinking about one thing Americans don't do enough of, which is also ensuring they're investing for the long term. So have the near-term plan, but make sure you're setting aside and keeping a long-term investment horizon, responsible, diversified portfolios. And if you think about those both together, you're more likely to be successful in meeting your goals.
So, all right. A lot of people can wait to the New Year's if they want, but what if you want to just start now? What if you want to say, okay, you know what, tomorrow's Friday, and for Friday onwards, I've got a new resolution for my life, and I want to make sure that I kick it into motion. How can you take those steps ahead of New Year's, ahead of the changing of the year, in order to really set up some good and achievable steps and goals along the way?
So again, before end of year, the first thing I'd be saying is take advantage of opportunities in a calendar year. Planning for college, as an example. There are calendar restrictions on that. Do that now and be talking to an advisor about how to put that to work. The tax loss harvesting opportunity for a lot of gains in the portfolio, S&P up meaningfully this year. It's a moment to consider taking smart gains, but not just taking the gains and moving the money out, but thinking of how to diversify your portfolio responsibly and rebalance now before the year is over. And third, as you're doing that, you don't have to wait till January 1st to start thinking about spending and saving, especially with the holidays, especially with people giving gifts and receiving gifts, getting your end of year, potentially bonuses and the like. Don't wait until someday later in January and February to make that decision. There's no time like the present.
Say you're trying to make a smart resolution with that bonus for next year. What are the ways that people can deploy that bonus that is going to set them up well for the rest of 2025?
So first, it's not just save it all. Look, we want people to go out and enjoy and reap the benefits of what they've earned. Okay. So I'm not going to come in and say, go put that all into a long-term
Thank you. You're telling me to book that travel, right?
I am telling you to book that travel responsibly. But as you're doing that, also keep in mind, what share of that do you feel you've got to set aside? Sure. And again, in that, there's a lot of attractive investments that people are throwing today. Again, our argument at Edward Jones is we believe in the long-term investor. The long-term investment philosophy has always won out. And we'd say, especially given the froth in the market, a high volatility, it's a moment not just to set aside the money, but to take a moment and think how to responsibly allocate that in a way that will meet your goals again, over near-term and longer-term horizons.
You know, as we think about the areas of strain and where people can set themselves up and have an emergency fund, but also make sure that they're offsetting what could pop up and become financial stress. Everything from caregiving costs, thinking about their business, and for small businesses, unforeseen costs that could arise as well. You know, how should you be thinking about that emergency fund holistically so that when anything pops up, that you're well prepared to take on anything, whether it be family-based or business-based?
Well, look, you want to set aside a certain amount of money. And again, the percentage will vary depending on income, also depending on your starting point. But you should decide that plan and bring, again, a friend or a professional in to help you do that. Again, right now we're in a period where markets are high. We're also in a high rate environment where you can earn more on savings set aside in an emergency fund. And again, you can invest it responsibly. So I'd say it's a moment where you should be thinking about whether you're a homeowner, whether you're thinking about saving for college, whether you are just thinking about making payments month over month. It's responsible to ensure you've got a certain percentage there set aside and that you're looking to make the best of it and growing it, not holding it static. David Schuback of Edward Jones, Head of Branch Development and U.S. Business Unit. Thanks so much for taking the time here. Thanks for being here. Happy holidays. Absolutely. Let's do a final check of the markets here as we're taking a look at the Dow Jones Industrial Average, the S&P 500, and the Nasdaq. We're seeing fractional gains across the board here, 0.5% in gains for the Dow. S&P 500, that's higher by 0.7%, and the Nasdaq Composite, that's higher by about 0.9% right now. We'll continue to see if we can cut into some of yesterday's deep declines. That's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time.